banks are fragile in this fragile world, and the too big to fail are reaping the benefits.
If we don't have a big recession, as many people think we are going to have, the credit problems for the banks will not be that severe.
What we're seeing now primarily is deposit flight. In other words, it's a liability side problem.
There's something sick within these financials.
Right.
What that is, I think, will reveal itself over time.
We haven't seen the end yet. I don't believe we have.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a mess. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market just about positive on the S&P 500. Some of these regional banking names, anything but. PacWest, Western Alliance, absolutely slammed in yesterday's session. This morning, Tom, PacWest down another 12%.
12% down now, just giving way as we go to air here, giving way again. It seems like an alphabet soup, John, where we have to keep up with the symbols to see which symbol matters this morning. To what Chris Verone said in the opening credits there, I don't think we know which ones are going to be Thursday or Thursday of next week or Thursday a month from now. What a conversation. Kaplan of Dallas, the former Fed president, alluding to the mysteries we have out there on these regionals.
Bank pain might just be getting started. His precise words were these. I actually think the banking situation may well be more serious than we currently understand. Chairman Powell just around the corner. Lisa, here's a question for you. What is this Fed hiking into?
They're hiking into weakness, and pretty much everyone knows that. The lag effects are here, and that's what Bob Michael had said a couple of weeks ago, and that seems to be present here. The unknown here is just what oversight we have. When Robert Kaplan talks about how this isn't the end, what is he talking about? Is it the drip, drip, drip of deposits? Is it just general pain, or is there something else?
And this guy is the qualified guy. This is not some monetary PhD. He's no Claudia Sahm. Good morning, Dr. Sahm. Respect to you and your conversation yesterday. Kaplan is a finance guy, a Goldman Sachs guy, and he's a guy just steeped in the dynamics, John, of Southern banking. I think culturally for our international audience, these banks are a different fabric than maybe what you'd see in New York. Julian Emanuel moments ago reaffirming Ed Hyman, second half recession.
Evercore, here's the call from them. Potentially self-fulfilling speculative attacks on regional banking names. CFRA frame it pretty neatly. More deposit outflows lead to less lending, more expensive funding costs, and thus less profitability. And Lisa, at the same time, you look up on a TV screen, you listen to the radio, advert after advert, 4%. Open an account, we'll give you 4%. These regional banking names cannot afford to do that.
That's the issue, is that the margins are just getting squeezed. And this is a profitability story, but why would you go into a bank that has profitability challenges and might have difficulty lending in this kind of environment? The notes that I've been reading say that without some sort of policy response, backing the regional banking system in a more comprehensive way with perhaps insurance, with something else, it's hard to see what's going to stop this trend.
This goes back to a quote that Tom and I discussed yesterday from a professor at Cornell in a fantastic piece from John Authors on the Bloomberg terminal and on Bloomberg.com, when he said this: we have two choices before us. Either we preserve our production-focused regional and sector-specific industrial banking systems by removing FDIC insurance limits immediately, or, Tom, we allow financialized Wall Street banks to take all.
Well, the financialized is the word here, and that's where the Fed comes to the rescue. This meeting is a snooze this afternoon. Can we all agree on that?
No,
25 beeps,
absolutely
maybe?
not.
But what he says about the financialization of the American financial system, the world of Chris Whalen, to be honest, is going to be absolutely historic. How many prepared statements is he going to have? You know, they're going to be a question. I got the wrong form. Let's pick up this form here.
There's going to be a lot of reading from sheets of paper, without a doubt about that. The one thing that I think we all want a preview of is the Senior Loan Officer Opinion Survey that was due to be unveiled next week. They should have some of that data. Mike McKee and I have been talking about that, Lisa. That's been a focus for you and I now for a number of weeks.
So how much does that change the tone, and how much does that really feed into dissent that we might hear for the first time in a meaningful way as there starts to become perhaps a bit more divergence among Fed policymakers?
Potentially in both directions as well. We can discuss that in just a moment. Here's the scene for you this morning. At the index level on the S&P, no sign of stress. We're positive 0.2% on the S&P 500. In the bond market, what a couple of days to start start a brand new week. Monday, the whole curve shifts higher by 10 basis points. Tuesday, the whole curve shifts lower by 10 basis points, plus 339 on a 10-year right now. We're down another 3 basis points on the session. Going into the ECB tomorrow, the euro still north of 110, 110.38 on a euro against the dollar. And I've got to finish on crude just briefly. Bramo, briefly. WTI dropping below 70 for the first time since March. Crude in London below 75 for the first time since March. Crude starting to break down a bit more.
Concerns about recession, and that really is what we feel. Before we get the Fed decision, we get economic data, including ADP employment change at 8:15 a.m., as well as ISM services for April at 10 a.m. Curious to see the ADP report after yesterday JOLTS data came out with the fastest decline in job openings ever. But also what we see is definitely this ongoing weakening in the labor market. Is it enough? At 2 p.m., we get the Fed's rate decision, followed by the news conference half an hour later. We're going to be speaking with Rich Clarida, Torsten Slok, and Bill Dudley for our special. It starts at 1:30 p.m. Eastern today. And we also get earnings, a slew of earnings. I want to focus on Qualcomm. The key for me is really the chip sector. How much are we entering some sort of downdraft, bottoming out before recovery at a time with so many questions?
Lisa, thanks for that. Looking ahead to the earnings a little bit later and tomorrow as well, of course, Apple coming up after the close. Joining us now is Christian Nelting, Global CIO at Deutsche Bank Private Bank. Christian, let's go through the names together. SVB, Signature Bank, Silvergate, Credit Suisse, First Republic. Yesterday, the stocks of two banks getting absolutely hammered in the US. How many more of these things do we need to see before we stop calling this idiosyncratic?
Yeah, I mean, it's a good point, right? Is it idiosyncratic risk, or is it really, are we entering a banking crisis here? I do still think it's idiosyncratic, although you could say if there's too many, it's not. I agree with you. But I think the market wants to see solutions to those banks named, and there's not really a new name coming up, to be very honest. So I think you need solutions for that. And I think the Fed will also take this into account into their meeting, but those names need to be seeing solutions. Otherwise, I think it will cause further volatility. But as you said rightly, right, the whole index level is okay. So I think you need to focus on these US regional banks, also from a global perspective. Right. And once you see solutions, I think things are getting better.
Christian, I did a very fancy technical study today involving log y-axis, Fibonacci's. I had smoke burning and incense about the price of bonds, the price of debt, and we are nowhere back to the middle tendency of the low rates we had. How far does the Fed and other central banks have to go to find stability and normality within the bond market, which folds right over to the banking industry?
Yeah, that's a good discussion about the terminal rate eventually, where the central banks are going. So I think the Fed will do 25 and then put what everyone now calls this hawkish pause. But I'm not in the camp of Fed cuts at the end of this year already, because I agree with you. We probably need at least a higher level for the time being, because first, I think inflation is quite sticky, and we are not back to, in, let's say, historical terms, in an environment where yields have been. So from that perspective, my view would be we are not going as high maybe as in past cycles, because we are coming from a very low level. And I think the absolute number of hikes also has a role to play. But that's why we are not in the camp of cuts.
Christian, just to build on what Tom is talking about, and John was talking about the whipsawing action that we've seen in benchmark Treasury yields, what does the Fed have to do to get this under control? Is this a credibility issue? Is this just basically a messaging issue that's been all over the place, or is this not their job?
Probably not their job, to be very honest, but of course their job is to look at market stability. And if you look at the bond market volatility, that has been much, much higher than equity volatility, which is quite unusual. I think if you look at the heights of the corona crisis, you had high bond market volatility, but even higher equity volatility. That has not been the case. I think it has triggered because of this high uncertainty we got last year on how far will the Fed go? Are we entering a hyperinflation? Now you can see still, I agree, very high volatility in the bond market, but if you compare to last year, it has been coming down. And from that perspective, I think that's the trend we will see once the market realizes at least the Fed has been at a level where it stops now. I mentioned the hawkish pause, and probably the ECB coming in tomorrow is doing a bit more, but then also will come to a stop.
How destabilizing, though, Christian, are some of these swings?
Sorry, say again?
How destabilizing are some of these swings in yields?
Well, I think from the perspective, if you need to build as a bank, as a company on yields expectations. I think, of course, it's destabilizing if you have high volatility in the yield space, and it's quite unusual to have such a high volatility. But I think if we are getting to a normal environment, I think people will need to deal with that. I think it would also be wrong, to be very honest, to assume that bond volatility would be super high as it has been now for many, many years. I think where we are in the cycle, given what we expect on rate hikes, that volatility should come down, and that's stabilizing. But I agree, it is destabilizing if the volatility is so high on the bond side.
What's your favorite investment idea right now, Christian, just out of interest?
So what we are doing is, first of all, we are cautious on the equity side, so underweight equities, but then, and that's the most important for us, not only now, but also going forward, probably for the next 2-3 years, because the environment is changing. If you look at index level themes, okay, you need to look at the long-term investment themes and reshape your portfolio there. So it's medtech in the healthcare space. That's one I really like because there are so many changes coming ahead, and it's a bit more defensive play. So that's really something we look into.
Christian, thank you, sir, for being with us. Christian Nolting there of Deutsche Bank, private bank, of some of the difficulties in the banking sector in America right now. Fantastic conversation with the former Federal Reserve Bank of Dallas President Robert Kaplan yesterday with our colleagues yesterday evening, who basically pointed out that we've had the rate shock. That's what's been working through the banking system. Tom, what we haven't had yet, and this is the more potentially serious phase of all of this, is the credit shock. We've had the rate shock. Will the credit shock follow?
This is you mentioned the financial. I'll get it out. 3, 2, 1. The financialization of the banking system, and there's a point where you go over to real assets, where you go over to the balance sheet, assets, liabilities, and such, and that's the angst in banking. Take the idea of deposit dynamics. Do we know what those are for PacWest? No, we don't. But what we really don't know, as mentioned by Gerard Cassidy yesterday, is the real haircut right now that has to be priced into those banks. That's getting over to the tangible market versus interest rate dynamics in the financial part of the market.
Just on the deposit side of the story, the most recent update we had from some of these banks that we're discussing this morning is that actually things had stabilised. Lisa, the first quarter wasn't good. We're not going to dress up this one, but things had stabilised since the end of the first quarter coming into 2Q. So this is going to spook them, I imagine, all over again.
This is the problem, though. At a certain point, if these banks stop lending, let's say that they do get stabilization, then all of a sudden companies are in a worse position because they're not getting loans. And then it builds on itself. And that cycle is getting people nervous.
It becomes self-fulfilling to some extent. Equity futures right now positive by 0.2%. A Federal Reserve rate decision just around the corner. Another bank has failed this week. And yet this central bank is set to hike 25 basis points once again. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve appears ready to signal a pause to its aggressive interest rate hiking campaign, but not before raising interest rates another 25 basis points. Policymakers wrapping up their two-day meeting today. Tighter lending conditions and signs of a slowing economy suggest inflation cool more in the months ahead. The dwindling number of days before the U.S. reaches its debt limit is raising the chance of a short-term extension. Even that solution would force a messy political choice. Either Republicans break their vow against approving a clean limit debt increase, or Democrats concede and agree to discuss spending along with raising the debt ceiling. The Treasury could run out of sufficient cash by June 1st. The UK plans to loosen IPO rules to make London more attractive as a financial center. That comes after a dramatic drop in the number of new city listings in the city. The Financial Conduct Authority wants to replace its premium and standard listing categories with a single offering in a bid to attract more companies. In Texas, law enforcement has arrested the man suspected of shooting 5 people in a neighborhood dispute. Authorities say Francisco Oropesa was found hiding in a closet underneath some laundry. According to officials, neighbors complained to Oropesa to police Friday night that he was firing a gun in his yard. The FBI says Oropesa then entered their house and killed 5 people. And Carl Icahn's fortune got hammered after short seller Hindenburg Research accused him of using a Ponzi-like structure at his investment firm. The company's shares plunged and Icahn's net worth dropped an unprecedented 41% to $10 billion. Icahn has rejected Hindenburg's claims. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I would prefer to do what's called a hawkish pause, not raise, but signal that we're in a tightening stance, because I actually think the banking situation may well be more serious than we currently understand it. I think we're in the early stages, not the late stages of this banking situation. We've just seen the first phase of this, which is the asset liability mismatch, which is sort of the most obvious issue, but the credit issues are about to start.
Just a fascinating conversation there with Robert Kaplan, the former Dallas Fed president, alongside our colleagues Heidi Lund, Sherry Yarn, Kathleen Hayes, having that conversation with him yesterday evening. The credit problems are about to start. We've heard that from Charlie Munger of Berkshire Hathaway and the FT earlier this week. Katie Koch at TCW caught up with Shnali Basak a little bit earlier this week as well at the Milken Conference in California. Commercial real estate, Bramo, commercial real estate is a theme that people keep going back to.
There's a fear that we're seeing the lag effects finally start to take hold of what the Fed has done in terms of raising rates by the fastest pace, going back to 1981. Now, how much further do we have? And that's really the fear, that we haven't seen the worst of it, and it's going to percolate through the banking system with credit risk, with really a recession.
There's a new stock on the radar. You moved from First Republic. PacWest got hammered yesterday. The stock's down by 12% in the pre-market. Western Alliance, their stock is negative 7.5%. TK, there was an element of this, and I want to pick up on the language that Evercore used. Speculative attack. How much of this was just the shorts coming over from First Republic and slamming PacWest and Western Alliance into the ground?
Always going to be part of the discussion. I'm going to lead off with that with Ken Leon here. But, John, the idea that the shorts are there is because they have an idea of what's going on. And I would suggest at the end of the day, we haven't talked enough about deposits at these other banks. We were at First Republic, we were at SVB. What's the deposit mystery there right now?
Well, we know what happened in Q1. Dreadful.
Yeah.
And we know, based on their guidance in some of the calls and communication that we got around some of these companies, that things are stabilised. That was the latest we'd got from them.
Or so they say, and maybe they'll say something this morning, down 12% here in the pre-market. To continue our banking coverage, and we thank the many emails and comments we've had on the names we've had. Gerard Cassidy with us yesterday. Ken Leon joins today, Director of Equity Research at CFRA with decades of experience. Let me begin on deposits, Ken, and that is at a PacWest, we see published on the Bloomberg terminal $34 billion to $28 billion. Do you have any belief in deposit stability, or do people in Beverly Hills have their phones out on Rodeo Drive today transferring to J.P. Morgan?
It's a big story, and it's the silent majority. It's individuals, it's households that are moving out of non-interest bearing or low rate into higher rates, and this is significant, and this is kind of like the groundswell that doesn't get the attention, which is the disintermediation of just average people out there saying, I can get a 5% yield. So that's significant. That's the first battle. The second battle, of course, is what we're seeing with specific banks or what's being viewed as the bear case scenario.
Two things here, and to some extent they're interlinked, two worries. The worries about return of capital and then worries about return on capital. Do you think we've moved past the phase of worries about returns of capital and we're now firmly in the grounds of people saying, I can get 4-5% elsewhere, I'm gone? And does that move around return on capital, that phase, just take you back to square one all over again? Does that fuel concerns about return of capital?
I wish that was the only risk for the banks, which essentially is, coming off Basel III endgame, higher capital buffers, or perhaps because of what's happened here in the U.S., that we do see a raise on capital. But that's the intermediate, John. And I think what's notable today is that it's easy for the bear case scenario, which is not us, says that we saw earlier that all of a sudden, the backstop essentially for banks on M&A is to wait till they get to the FDIC and you get a lost share agreement. So it's hard to have a premium for some of the smaller banks. And secondly, it's the opportunity where these banks have a difficulty in defending themselves, mostly more to perceptions than substance to what their balance sheets look like today.
Well, but Ken, in fairness, if we do enter a recession, based on the stress that some of these firms have already experienced, are they really strong enough to withstand both deposits coming out and true credit risk in some of their loans?
I also cover in real estate the office market, and that will take 6 months or longer. But as you move into the credit risk or that part of the balance sheet, there's certainly going to be greater concerns or fears, which gets into the market much earlier than when we can see, the impact. And of course, it's going to be more significant for the smaller banks than the larger banks. What we're going to see looking back 3 years from now is that 3,200 banks might only be 700 or 800, and the publicly traded banks is going to be much smaller just because it's hard to defend when you have these waves.
But that implies, I got to rip up the script here, Ken Leon. Your mathematics there with all your experience tells me the fifth bank of the United States, JP Morgan and Bank of America, are going to consolidate and get ever larger. Is that where we're heading? Are we on the edge of a Canadian or European structure?
We're moving in that direction, and quite honestly, Senator Elizabeth Warren can talk about too big to fail and trying to make banks smaller, but that's a story from years back. We're in a new environment, and from the standpoint of financial stability, it is important for the Fed and regulators to look at this and see that there is benefits with scale. So that's the direction we're moving.
Ken, just a final question from me. I'm just thinking about all of these difficulties and trying to work out what a circuit breaker might be. There's been so much talk about the Federal Reserve being able to use other tools to deal with this situation. Can you think of a circuit breaker that is not just rate cuts? What solves this?
Well, we would say months ago it would be quantitative tightening or easing, playing around with mortgage-backed securities and treasuries, or what's at the Fed window, which was true in the first week with Silicon Valley Bank, where you went to quantitative easing with $400 billion at the window. Those aren't the issues. Unfortunately, the Fed walks slower than the markets, and ad nausea this weekend, reading all the reports, the supervisory reports, it's going to take time for them, again, to check all the items on the list to make sure smaller banks are safe. So, again, there's different pace. And unfortunately, the markets move much faster than regulators or the banks.
Was that a yes, Ken, that we need rate cuts?
No, not yet.
Ken Leon,
Leon, Fed watcher.
Ken, thank you. Appreciate it. It's not just about being a Fed watcher, TK. It's about whether these banking models demand lower interest rates. Can regional banks get by without lower interest rates? You think about where the pressure's coming from. He's talking about deposit flight for a better return on capital, because you can get 4-5% elsewhere. We know that these banks, these institutions, have got a lot of loans that are essentially at 2-3% mortgages. Lisa, that's problematic when you've got to offer 4-5 to keep deposits.
We're working in a vacuum. Keep thinking about what Ken Leon says. The market moves so much faster than the Fed, right? And they're identifying these issues and saying that these models are unsustainable. I feel like this is someone working out really intensely, and they know it's going to hurt later, and they're not sure how much, so they keep going, and then later they might be put out on the bench for 2 weeks, right? And that's the issue, is we just don't know how much more pain there's going to be that's going to be felt in this system.
It may be creative destruction and Schumpeter, but I would really call it the clearing of markets, and you have to clear this out, and it takes a time function, yes. But my experience is, and John, this is an old British phrase, OBE, which I associate with Margaret Thatcher, you're overcome by events. This is a Fed that is going to become overcome by events. That's certain, in my opinion.
I think we talked about this last month. SVB went under, they still hiked interest rates. First Republic's gone under, they're still about to hike interest rates. PagWest is down another 13% in the pre-market.
Ian Bremmer and others had out the inflation-adjusted failure, and basically what we've seen, John, is a Washington Mutual equivalent from 2008. We're there now.
Bruce Kasman, JP Morgan, coming right up from New York. This is Bloomberg. Fed decision day, 25 basis point hike just around the corner. This is what things look like in the market right now. On the S&P 500, equity futures positive by 0.2%. On the Nasdaq 100, positive by 0.2%. There's some calm here at the index level. Some calm which I think masks what's happening elsewhere with some of these regional banks, and we can talk about that in just a moment. Looking at the bond market, 2s, 10s, 30s. So on Monday, Let's walk through Monday. Monday, we get prices paid on the ISM manufacturing coming in hotter than expected. Yields higher. Meta, a bunch of other companies come out, issue some debt, kick around the Treasury market a little bit more, yields higher. Then, on Tuesday, we get the banking stress, and we unwind all of that move and some, and we're back down below 4% on a 2-year to 395.31, on a 10-year to 340, yields down there a couple of basis points too. That's going into the Fed, looking for 25, going into the ECB on Thursday, with a euro looking like this against the dollar. Euro-dollar at 110.36, firmer by a third of 1%. SocGen this morning, Tom, Kit Juice.
What did they say?
Talking about the prospect of 50. I think JP Morgan looking for 50 as well from the ECB this week. So a couple of banks out there looking for 50, not 25.
And Kit Juice saying, everybody, let's be prepared to be surprised this afternoon. Of course, we'll do that at 2 p.m. with our special coverage. The Fed Surprises is the new title for the show. John, moments ago, a nice break of $70. West Texas Intermediate, 69.55. Tell me what that signals of the stag. And it's Stag Wednesday, folks. Forget about the inflation part. We're very staggy in the last 24 hours.
Saw that a little bit earlier. First time since March. A break of 75 on Brent crude as well. Again, for the first time since March. A little bit earlier this morning. Two banking names get our attention. Let's focus on them just briefly. PacWest, Western Alliance got hammered yesterday. We're down 12% on PacWest in the pre-market. Western Alliance down 4.6%. And yet still, at 2 p.m. Eastern Time, we're expecting the Federal Reserve to hike interest rates. Wall Street out with their forecast. The 6 biggest banks all calling for 25. Bruce Kasman of JP Morgan running this. We see the Fed delivering a 25 basis point hike while also maintaining, let's have a look at that quote, a hawkish bias. Tom.
It's a hawkish bias, and of course the word hawkish is also in, and we'll see what the template is here at 2 p.m. and on to that important press conference. Our Michael McKee, of course, asking questions. Right now, Bruce Kasman joins us with J.P. Morgan, their chief economist. Bruce, I want to go larger with you right now as your mandate of your wonderful weekly prospects on Friday. The IMF stunned with a 5-year view of tepid global growth. The fact is, moments ago, West Texas Intermediate, the banner I have is 69.60, and right now we're already at 69.57. Is oil one of the metrics leading us to a global slowdown as the IMF called for?
I don't think right now oil, given everything that's happening geopolitically, given how the market is segmented, I don't think it's telling you very much about growth directly. I'll put more weight on what we're seeing in terms of the survey data, the high-frequency indicators. It's telling us that the U.S. is pretty sluggish here and is probably lagging the rest of the world. But global growth is actually picking up as we move through the first quarter and into the second, with China and Western Europe doing quite well.
Well, this is critical. I'm going to rip up the script here, let Lisa and John carry the weight on the Fed and all that's going on today. Reaffirmed the J.P. Morgan call on China 12 months forward. There's some doubt about the Chinese economic expansion. Do you agree?
Well, I think there's plenty of doubt about where China is going to be over the medium term, but I don't think there should be much doubt about the fact that this is an economy that it's reopening, that it's got very depressed levels of activity, and that it's got policymakers, which I wouldn't call supportive, but they're definitely moving away from what had been quite restrictive policies last year. I think we're going to see about 6.5% China GDP growth this year. At some point, that's going to fade, but I don't think it's going to fade till sometime later this year. And we still have quite a few months here of China's strength ahead of us.
Bruce, let's get back to the topic at hand. The Federal Reserve a little bit later. The language in their statement from their last meeting, the committee anticipates that some additional policy firming may be appropriate. We're going to get that additional policy firming today. How do you expect the language is going to change, if you expect it to change at all, in this statement?
I think it's going to change to be more equivocal. Instead of talking about some additional policy firming, I think they'll talk about any additional firming will be dependent upon, and then talk about both the economic conditions as well as its assessment of financial conditions. So it's going to be an equivocal hawkish bias. It's not going to point directly to tightening. It's going to keep the conversation, though, on the possibility of tightening.
Do we have a sense of the balance of risks right now, Bruce, in terms of inflation reaccelerating versus a financial market crash or just an economic crash with lag effects just starting and the regional banks being the opening salvo?
So, as you noted, there's a lot of risk here. There's inflation, which is still elevated and is showing quite a bit of persistence. There is stress in the financial system. And I think we should put also in the mix is that everything that we see is telling us that we have a pretty underlying strong private sector here. This is not a private sector which is fragile. And the way these things interact is going to be very interesting to see. From our own point of view, we think the economy is less likely to slide into recession in the near term. We think inflation is not going to come down. And we think the Fed is going to pause in the face of these uncertainties. And how that plays out 6 months from now becomes really an interesting story. We do think the credit drag will be material and start to build, but we don't think inflation is going to come down by itself. So the case for Fed easing here anytime in the near term, I think, is not that strong.
But put aside the easing for a second, even just staying with rates above 5%, there is a question at a time when you see the job openings come down at a record pace, when you see this idea of smaller banks that are facing an existential threat as people try to game out what that credit stress will look like. How do you get the sense that inflation is still the preeminent concern?
Well, obviously, it's not a preeminent concern that the Fed is going to be pausing with run rates on inflation well above 4%. So I think what you're seeing from a Fed and what you'll see today is a Fed that is worried about inflation, but is balancing it against the backdrop of concerns about financial stability, as well as, of course, the idea that it's moved a lot very fast and it may be desirable to take a pause. This is not a Fed that is focused entirely on inflation, far from it.
Bruce, I see compare and contrast to 2008. Last night I saw an inflation-adjusted bar chart of the Washington Mutual and Company debacle of 2008, inflation-adjusted out to the number of banks we've seen recently that are troubled as well. When does the Fed blink? I mean, how far does that bar chart have to grow up for 2023 before, when the facts change, I change at the Fed?
Well, let's just say, first of all, the Fed has blinked. Powell, at his congressional testimony, talked about raising the terminal rate significantly. They didn't do that. They're now moving towards a pause. I think we've gotten a shift of about 50 basis points from the Fed in terms of guidance here, which isn't based on what we're seeing in the economic data. So I think the Fed has shifted. I think to get the Fed to think about easing in an environment where inflation is as strong, we need to see growth break, or we need to see a generalized financial crisis take place, neither of which do we think is going to happen anytime soon.
Well, I'll take your point, Bruce, on a generalized financial crisis, and we don't see that. But to go back to Maynard Keynes, when the facts change, the Fed will change. How close are we to that, given FDIC, given Senator Warren and all the other distractions of the day? There's a point here where Vice Chairman Barr says to Chairman Powell, we've got a problem.
Right. And I think we're seeing the Fed operate on its liquidity facilities. I think we're seeing the Fed move to a pause in an environment which they otherwise wouldn't. The question you're asking is the Fed going to preemptively ease without the economy having shown that damage? I would also just note here that in terms of the way financial markets are functioning more broadly, they're still functioning quite healthy. There's a lot of credit being issued in the market. There's a lot of private funds of equity. We're not seeing spillovers to the dollar and the rest of the world. I think we have a significant risk here, and I don't want to ignore that risk, but I think you're going to need to see that risk realized in a far more tangible way before you get to talk about the Fed actually easing here. Of course, if the economy breaks and we're sitting here on Friday with a negative payroll report, we'll change the conversation. But I don't think that's the likely path we're going to see in the economic data.
Hey, Bruce. Great to catch up.
Should we quote him
Thank
on
you,
that
sir.
now?
Bruce Katzman at JP Morgan. We'll look ahead to payrolls. We're looking for something like 180,000 on Friday. Certainly not looking for a negative print, though. Who knows what we're going to get based on what we've seen so far after the last 12 months. Surprise after surprise with the resilience of this labour market. 3.5% unemployment does not scream rate cut, does it? This economy right now, a lot of people might say, does not scream rate cut right now. But if you're a regional bank, you've got a very different opinion, Lisa, on what you'd like to see from monetary policy later today.
And so who do people in the market trust for some sort of projection of what this means going forward, right? Not where we are right now, but where we are going to be in 6 months. And Steve Chiavarone basically came out and said, how many risks can the Fed underestimate? Inflation, the impact of rate hikes, banking stress, the list keeps growing. At what point has the Fed lost the upper hand when it comes to guiding markets and what to expect?
I like what Dr. Katzman said about you need a more holistic sense of bad events. But the fact is, we're going bank to bank, and you go, why? And it's this huge move in interest rates. When I look at the geometry on the Bloomberg terminal of the increase in rates and where normal is, guessing where normal is, John, we're not close to normal. We have a lot of work to do to get price up and yield down as a general statement on the Bloomberg indices, the old Lehman and Barclays indices that Bloomberg has now. From a Euclidean basis, we're miles away from this desired word normal.
These regional banks have been totally exposed to the rate shock of the last 12 months in a way that a lot of people didn't anticipate. I want to go back to what Robert Kaplan talked about, though. This was the rates shock. Not had the credit phase of this, and maybe we will, maybe we won't, because a lot of people are going around, Lisa, saying we don't have to leverage in the system this time around, but this is just the rate shock, never mind the credit issues.
And that's what Dick Beauvais says of Odeon Capital, who just writes in and says, you guys just do not get it. This is the 1986 S&L banking crisis all over again because of just that. First, you make things more expensive for them to be able to finance, then they can lend less, then that lending ends up creating a more negative credit backdrop, and then their loans start to sour, and et cetera, et cetera. This we have not priced in.
That came from a very high interest rate standpoint versus where we are now, and the acclaimed Dick Beauvais and the history of that, John. The number one thing to me is it's the rescue culture, as Rashir Sharma says. We're trying to do this now where no one gets hurt, where in 1986, it wasn't me and Dick Beauvais, but people are out there, John, on the weekends going, okay, we need to close 4 banks. You go to Philadelphia, you go to Texas, and you pour the short straw. You've got to go to some other state you didn't want to go to that weekend.
Do you want to say what state that might be?
No, I don't want to say what state that is. Dick Beauvais will tell you what state that is.
Who are you guys? Who's you guys?
Thank you for watching,
He's
Dick Beauvais.
sending us
you
from North
guys.
Dakota, which is fine.
Is it hate mail to us?
Yes.
Okay.
Yeah, no. It's basically that we're not portraying it correctly, which is fair.
Haven't we talked about
that? But this is the issue. Is it a crisis? Is it not a crisis? It's not necessarily 2008. Is it 1986? We just don't know.
You guys, what happened to being polite? Just, dear Lisa, I've been following the programme, and I'd just like you to take a listen to what I've got to say about this.
This is Wall Street. Just be blunt. Come out. You're wrong.
Why is everyone so rude? And read a set of energy aspects coming up.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The Federal Reserve is expected to deliver its 10th consecutive rate hike today since March of 2022. Now, another quarter-point raise is anticipated and possibly the last in this cycle, with tighter lending conditions and signs of a slowing economy pointing to cooling inflation. That decision will be announced at 2 p.m. in Washington. The U.S., Europe, and other Ukrainian allies want to close more Russian sanction loopholes. The plans will be unveiled at a G7 meeting this month. Multiple rounds of sanctions and other economic penalties imposed on Moscow since its invasion of Ukraine have battered Russia's economy, but they haven't delivered a knockout blow. The Biden administration will deploy 1,500 members of the U.S. military along the border with Mexico. A surge of undocumented immigrants is expected once pandemic-era restrictions are lifted this month. The troops will not serve in a law enforcement capacity and will not interact with migrants. Eli Lilly's experimental drug for Alzheimer's slowed the progress of the disease in a final stage trial, and that paves the way for the company to apply for U.S. approval. Lilly said today the drug slowed the disease by 35% over a year and a half. The company has spent billions of dollars and decades of research on Alzheimer's. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
You have a banking crisis that's unfolding in the context of the credit squeeze. You already have a cost of living crisis, so you have recessionary headwinds. All of that's manifesting itself into weaker demand. You've got surpluses in oil from Iran, from Libya, from Venezuela. And ultimately, my concern here, Alex, is that while that could see a further reduction in oil, all that does is create massive supply risks in the future.
Great to catch up with Christian Malik there, the global head of energy strategy over at JP Morgan, weighing in on the crude market. Right now on oil, if you're waking up this morning, a break of 70 on WTI, first time since March. We're down 3% there. Brent crude in London, 73, a break of 75 for the first time since March. We're down by close to 3 percentage points there as well, negative 2.85%. That's the move in crude. Let's get to the moves elsewhere in the broader equity market. Equity futures on the S&P 500 look a little something like this. Equities positive by 0.2% on the S&P. Yields coming in a couple of basis points on a 10-year, 339.94. Yields up in a big way on Monday, down in a big way on Tuesday. The volatility in this bond market all over the place. And just to finish in foreign exchange, the euro, 110.33 against the dollar. Stronger euro, weaker dollar, off the back of that move in yields lower yesterday. I just want to round things up with a couple of names for you, single names, the banks, which I know you're all following at the moment. PacWest kind of bouncing off the bottom a little bit. It's down about 9% in the pre-market. Western Alliance doing a little bit better as well this morning, Tom. Relative to where we were about an hour ago, we're down about 4.6% there.
On top of these stories, and again, we'll see how it unfolds, talking about the shorts and also talking about deposit mysteries as well. Joining us now on oil, Amrita Sen, co-founder, director of research at Energy Aspects. I get the growth slowdown story, Amrita. I want to go to a British phrase, elasticity, which I can't stand. Americans are like, say what? And the answer is, I'm going to use responsiveness. What is the responsiveness of oil to a China slowdown? I mean, in a global slowdown, a stag part of this debate. What is the responsiveness of oil demand?
I mean, obviously, Tom, oil demand is driven by economic growth. So in China in particular, has been the biggest driver of oil demand this year so far, and it's expected to remain the case next year as the economy is still opening. I do think a lot of the China slowdown fears are a little overblown because the slowdown has been mostly in the manufacturing side, which is due to the fact that the US and Europe are simply not consuming and buying enough goods. The consumer side in China remains extremely strong because of the reopening. And I'm not actually very worried about that. And oil demand continues to remain very, very strong on because of that. The problem really is in the West, right? You have monetary policy, which is pretty much, if I may say so, at odds with fiscal policy. Fiscal policy across US and Europe is inflationary. A lot of the green policies that are being enacted by the governments are actually pumping even more money into the economy. And we have central banks that have mandates to get inflation down regardless of structural supply side issues. And that's what's creating an enormous amount of uncertainty. Oil demand right now isn't weak. Even in the US and Europe, where we've already forecast declining year-on-year demand growth, demand's actually coming in better than we've been expecting. This is about the fear of what could happen to oil demand in the future.
Amrita, can you speak to Christian Malik's point, the fact that right now we're seeing people price in a recession into oil prices, at least in the West, at a time when there also is tightening credit conditions, which is going to lead to a lack of investment, which will cause oil prices to go much higher later on, even if they go much lower in the short term. Do you agree with that kind of outlook?
Absolutely. I mean, I think we've been saying this even before Christian's been saying this, that we have a structural supply side problem in this market, particularly between 2023 and 2026. You know, we first highlighted that back in 2018, 2019, because beyond OPEC and that to very few OPEC countries, nobody else has been investing. And the lower prices go right now. We've already seen shale pull back, and a tighter credit means that they will not be growing much anyways. You are actually going to see a much bigger supply side problem, which goes beyond 2025. I think that's the real challenge. Outside of Saudi Arabia, UAE, a little bit of other GCC countries, who else is even investing in oil?
How low could prices go before that pop? And I ask this at a time when we see oil prices being one of the disinflationary drivers, at least so far this year. If they become an inflationary driver back in 2023, 2024, 2025, this could create an issue. So how far down could they go before popping up?
I mean, I think in the short term, with all the issues around or the uncertainties around the U.S. debt ceiling, I do think we could see a 6 handle both for TI and for Brent. Of course, if genuine supply-demand fundamentals were to weaken, and that's the dichotomy we have right now. Physical fundamentals are actually strengthening as we speak. We've been seeing counter-seasonal draws globally, but particularly in the US since March. So, and OPEC cuts haven't even taken place. So if we do get a deterioration in supply-demand fundamentals, OPEC will step in again. But right now, no, because the cuts have to materialize. We need to see the tightening. What we are seeing in oil prices is just the fear of the uncertainty and pretty much, if I may say, being driven by central bankers and their policies.
Amrita, thank you. As always, Amrita Sen there of Energy Aspects joining us on the crude market. WTI 69, Brent crude 73, breaking down a little bit here. Looking forward to catching up with Anne-Marie in the next hour, and I'll tell you why. I don't think this got talked about enough yesterday. This letter, signed by 10 members of Congress to the Federal Reserve ahead of a Federal Reserve decision, Tom, I find absolutely staggering. We've criticised the previous administration so much for weighing in on Fed policy, and these 10 members of Congress, led by Senator Warren, had this to say going into Fed decision day. In advance of the FOMC and their May 2nd and May 3rd meeting, we strongly urge you to respect the Fed's dual mandate, pause your rate hikes, and avoid engineering a recession that destroys jobs and crushes small businesses. Now, I get this letter is signed by the usual suspects, but Tom, this is not the way it's meant to be.
I would partition jobs and small businesses. Jobs, as you mentioned earlier, John, seem to be pretty darn good. 180,000. Who knows what that number will be? I take a 3-month moving average, and the answer is employment is a massively lagging indicator, still is pretty good. But small businesses are basically flat on their back. I mean, that's my generalization around an economy where there's some states doing well, some regions doing well, but a lot of the rest of America, those small businesses are really struggling. And I believe small businesses is French for voters. I think that's how that works out. It's like voters.
What about independence? What's French for independence?
Voters. You know, independents are a unique American thing. Do they have independence in England?
Central bank independence?
No, like liberal Democrats, are they independents?
No, I'm talking about central bank independence.
Oh, central bank independence is a whole new thing here. I mean, this ended with Greenspan. None of this is imaginable under Greenspan.
So
and the way everybody's weighing in here.
It was wrong when the Trump administration did it, but it's okay when Senator Warren starts writing letters ahead of decisions.
No, I think it's an equal opportunity complaint society, but the answer is it used to be really quite removed. And it's after the financial crisis, it's not.
The Fed's always been politicized. It's been increasingly politicized. The concern is that we had expected a really kind of push-pull with inflation still so high that it would be more balanced at this point. The fact that it's getting politicized and pushing back against rate hikes this early, given where we are in inflation, given that we do still have a strong economy, points to just the political pressure, especially heading into an election cycle the Fed will come under later this year and into next. And that really raises a question about Fed credibility, Fed independence, as well as political interference at a time when there still are openings on the Federal Reserve Board.
This is happening with unemployment at 3.5%.
Exactly.
And to your point, some of these openings on this Fed board will have to be confirmed by this Senate. And you wonder whether this shapes the White House and the administration's view of who they should appoint because of who they can get confirmed by individuals that are saying these things ahead of a Fed decision.
It's especially fraught because we don't really know the trajectory of the economy ahead. We just had an incredible shock, both with the pandemic, both with respect to some of the geopolitical shifts. And suddenly, we're looking at an economy where half the people are saying that inflation is still the preeminent concern about just sort of stickiness there. And other people are saying we're careening toward some sort of recession, and it's going to absolutely implode the regional banks, and it's going to create a massive problem for the economy.
We've been careening for a recession for, I believe it's 2 years. John, correct me, maybe it's 18
At least 12 months.
Yeah, and Ed Hyman reaffirmed second half recession this morning, which is an important voice. I would suggest you go back to Fed 101, which is every bit of history says they're massively data dependent and on inflation.
On what data?
And on inflation and jobs. That's their mandate, and they happen to be lagging. I'll let Jason Furman tell us various shades of lagging data. So you have a various shades of lagging central bank, and that's where we are right now after 14 rate increases. Well,
I just think that letter is highly irresponsible, regardless who signs it. It's highly irresponsible because you can't believe in central bank independence when it suits you.
Yeah, I would go to Dustin Hoffman.
To do that going into the Fed decision is just a bit of a joke. Save it for the semi-annual testimony. Say what you want. Make a YouTube clip then.
Go to Dustin Hoffman and Hook. Bad form.
Yeah.
Bad form.
positive 0.1% on the S&P.
Banks are fragile in this fragile world, and the too big to fail are reaping the benefits.
If we don't have a big recession, as many people think we are going to have, the credit problems for the banks will not be that severe.
What we're seeing now primarily is deposit flight. In other words, it's a liability side problem.
There's something sick within these financials.
Right.
What that is, I think, will reveal itself over time.
We haven't seen the end yet. I don't believe we have.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Fed Decision Day, live from New York City this morning. Good morning for our audience worldwide on TV and radio. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market positive by 0.1% on the S&P 500. A focus on the regional lenders in a much bigger way again in the last 24 hours. Western Alliance trying to bounce in a pre-market, still negative 4.6%. PacWest negative 7%, trying to bounce off the lows. Yesterday, Tom, an ugly session for those two names.
Ugly session is a stagflation session with a slowdown in the economy. But you're right, John. It does come over to banking, and so many institutional players just saying, well, that was harsh. It's all over. And I got a lot of pushback out in media about First Republic being the end of this, and just a lot of experts just say, no.
Robert Kaplan, the former Dallas Fed president, essentially saying the same thing to our colleagues yesterday evening. Lisa saying this is just the rates phase of it. Wait for the credit phase.
And this goes to lag effects. We don't know what they are. And this is basically going to become a self-fulfilling prophecy when you end up having a situation where they're going to have fewer deposits. They're going to be lending into weakness at a time of rates staying high. How does this equation work with these banks maintaining some strength?
We've got a great guest around the table with us, so let's get straight to the price action. Your equity market just about positive by 0.1% on the S&P 500. In the bond market, yields up by more than 10 basis points Monday. Tuesday, yields down by more than 10 basis points. This morning, down 2. This is calm, Tom. 340 on a 10-year.
Calm. Is the FDIC going to come in and salvage oil? What do they do? Exxon to the rescue.
69 handle on WTI, Lisa. First time since March, early this morning.
Yeah, is this just basically gaming out a recession that hasn't happened yet, or is this really sensing out some true weakness? We'll discuss that. Today, the economic data before the Fed includes ADP employment at 8:15 a.m. We get ISM services for April at 10 a.m. Very curious to see whether there's a follow-on of weakness that we saw yesterday in terms of a big decline in the JOLTS data, the job openings data. At 2 p.m., the Fed's rate decision. 2:30 p.m., Jay Powell's news conference. We are going to start our program at 1:30 p.m. with Rich Clarida, Torsten Slok, and Bill Dudley among the guests who are going to join us throughout the afternoon for a Bloomberg Surveillance special. And today, earnings do continue. Qualcomm and Etsy after the bell, Zillow, TripAdvisor, Marriott. This grind is sort of the unspoken, right? That it hasn't been so bad, which perhaps offsets some of the concerns that people have that move into the recessionary projections that we keep hearing.
Zillow's up 30% this year? Really?
I wasn't aware of that.
Yeah,
really?
I actually did that this morning, and I thought to myself, I guess people think that the housing declines are over.
Well, what declines? When you're looking at certain markets, everyone's like, well, where are they?
Well,
I'd like them.
Exactly.
They're not coming.
You mentioned
100%.
Senator Warren's letter earlier. Crane's features today. This is really granular New York City politics, but they're looking at rent stabilization, John, and they're looking at a 16% lift for landlords.
Yeah, that doesn't sound like stabilization of anything, does it?
No, but, that's, again, an example of the microdata that Senator Warren in her letter to the Fed is alluding to. It's going to be fascinating, John. I do want to know if PacWest comes off the mat here. We need to thank
You're very
Ken
keen to
Leon
excuse
for
this
that.
Senator Warren letter. I've noticed that.
No, it's just the new way. It's not Greenspan. Greenspan was like, walls and
So long as we're consistent about this, that's fine.
I take your point, John.
Yeah.
I do. I think that there is a problem with creating a political pressure at a time where we still have risks that still are weighted to inflationary outcomes potentially, as well as a loss of jobs. That is something that is very important to recognize.
I just think that, from my perspective, it's not about the Federal Reserve today. It's about someone trying to get attention ahead of the Fed decision. It's about the senators who signed the letter. I think it's really problematic because this is happening with unemployment at 3.5%. If unemployment starts to climb, that pressure starts to build, and people start to believe, you get a perception shift. This is the real danger. People start to believe that the Fed is moving because of political pressure with elevated inflation. then I think you've got much, much bigger problems than just regional banks getting into some difficulty.
And some people would argue that's the volatility that you've seen in bond markets. That's the volatility that you've seen in a lot of risk assets because people don't understand this calculus. Where does the political risk come in at a time where the economic risk is so unclear?
Let the Fed do its job. Go and sort out the debt ceiling. That's what the politicians should be focused on right now.
That's too hard. Just ignore that. Just send a
letter. So much easier to send a letter.
It's their fault.
She's
it's
right.
Fed. Go for it.
Cut rates tomorrow. Okay. Victoria Fernandez joins us now, Chief Market Strategist at Crossmark Global Investments. Victoria, wonderful to catch up with you. We started last hour by going through the long list of names, the banks which have failed over the last 2 months, and whether we can carry on sitting here and saying it's idiosyncratic. Do you believe it's idiosyncratic?
To an extent, I do. I don't think you're going to see a Silicon Valley Bank, a Signature Bank, First Republic. I think those huge losses like that and those takeovers are probably done. What I'm concerned about is when you look at these banks, I mean, look at the end of last year, the end of 2022, their bank balances, the write-offs that they would have to do if they mark to market, it was like 28% of their total assets for banks across the board. People weren't really paying attention to that. If we go now and we get a commercial real estate issue coming more and more into play, that's 25% of loan books for U.S. banks. Small banks, it's 65%. Europe's in a much better place. It's only like 8% of their loan book. So we combine all that together, we get rates continuing to be higher, then I think we've got more of an issue. So not global, but not idiosyncratic either, kind of in the middle.
I would suggest you're hardwired to this, being from Texas, and I think that there's a whole much more regional bank spirit down in Texas and across the South out to California, where PacWest is. And what I want to do is fold this into what Crossmark, you, Bob Dole, and others actually say about being in the market. You allude to the Milwaukee Bucks. That didn't work out against Miami.
It did not.
And so let's go Fernandez and the Milwaukee Bucks here. You don't want to be the Milwaukee Bucks and exit the cash. So how do you play the market given the tensions Lisa, John, and I are talking about?
Yeah, so I think you have to be very selective in what you're doing. You're right. We don't think clients should come out of the market. We think you should stay in the market. But when you're looking at defensive really leading the way, when you're looking at high beta underperforming low beta, copper underperforming gold, you look at the leadership being very thin and breadth. You look at the Russell 3000 breadth line, it's at multi-year lows. So for us, that means you've got to be selective and focus on the quality factors that are out there. You want to look at strong balance sheets, good cash flows. You want to have some exposure, both cyclical and defensive in your portfolio, and you can do that. I mean, we bought CAT last week before earnings. That was a good play for us, but we also own like a Coke or a Pepsi. We own Cigna for healthcare. So I think you can go in and buy specific names. You don't need to come out of the market timing it with the volatility that we expect coming for the rest of this year. That's a really tricky game.
The volatility coming in the rest of the year, let's talk about the nature of that at a time when a lot of people say that the regional banking crisis is the opening salvo of the lag effects that are taking hold.
Right.
Do you believe that? Do you think that the stress is going to become that much more prevalent in markets, in companies, in corporate balance sheets, in earnings projections that we just have not seen yet?
Yeah, when you look at what earnings are doing right now, yes, they're beating, but from a very low bar, right? That was brought down pretty significantly. So yes, I think you're going to have a lot of problems. You still have valuation issues. Valuations are too high. We have the Federal Reserve today, obviously. You've got to work 500 basis points after today, 500 basis points through. Let's look at the ECB. Their unemployment actually went down, right? And inflation went up. So you're going to tell me they're stopping hiking rates? Not at all. We're still going to have global pressure for higher rates, even if the Fed pauses at the June meeting. Breadth is low. Like I said, we've got the debt ceiling debate. Let's remember in 2011, the S&P dropped 13% once they came to an agreement because there was a lot more austerity than what people anticipated. I think we might see some of that again. I don't think we get to the end of the debt ceiling issue and all of a sudden the market is strong, and a lot of liquidity is going to be coming out of the market after that from the Treasury. So,
are you looking for 50 tomorrow from the ECB?
I wouldn't be surprised if we saw 50 tomorrow. If I was sitting there, I think I'd say go for it. Do 50, and then let's see. But that's why I'm not sitting on the ECB right now.
Did you see the bank lending survey from the ECB for the Eurozone yesterday? Listen to this language. Imagine if you hear this from the Senior Loan Officer Opinion Survey next week. This is what they said. Banks reported a further substantial net tightening in credit standards for loans to firms and for house purchases. Demand for loans decreased strongly, driven by rising interest rates, lower fixed investment, and Lisa, weakening housing markets. That's Europe right now.
This is the problem. We don't know what the effect of that's going to be in terms of economic momentum that gets kicked out of the system. That's already happening with rates where they are. That's just Europe. In the U.S., you have to imagine that it's that much more extreme, just given how much further the Fed has gone. So how do you then take that into account, given that inflation is still high, especially in the euro region?
Tom, this is your world. Whether these central banks should act ex ante or ex post when you start to see information like that coming from the banking sector.
I stood with Richard Timberlake, the giant of the Georgia School, in our Washington studios years ago. I believe he was 91 or 92 at the time. Rail thin, wonderful guy. And Dr. Timberlake just made it absolutely clear in every instance, every case, they find comfort in an after-the-fact analysis. Why is this afternoon at 2 p.m.? Or Lagarde, is it tomorrow, John?
Yep.
Lagarde's in the same position, even with her unique purview as a politician, not as a monetary expert.
How comfortable would that view be? Victoria, thank you. It's good to see you in person.
Likewise,
Victoria
my
Fernandez,
pleasure.
across Mark. How many years has it been? 3?
It's been a while.
3 plus.
It's been a while.
It's been like 3+ years since we've seen some of these guests in person.
Yesterday, I
It's
teared up.
Crazy.
I mean, there was like 3-4 guests in a row in the studio. I mean, we used to be in here hermetically sealed. It was like in the movie E.T. when you had to go through. John used to wear keys on his belt that would clang around. You know, that was...
Is that right?
Yeah, that was a pandemic.
When we were separated for so long.
The keys? Really?
I don't know what the keys are about.
I'm not sure.
It was amazing. Chris Verone was in yesterday. He has DNA.
Who's E.T.?
Don't ask.
Okay,
Coming up
cool.
in the next hour, John Lawler, the Ford CFO. Looking forward to that conversation. If you're just tuning in, congratulations. Your equity market's positive by 0.2%.
All day.
On the S&P 500. Your bond market looks a little something like this. Yields lower by a couple of basis points, 340. Going into the Fed decision a little bit later on this afternoon. The consensus view is simple. We're looking for 25. Many people assume they will communicate some kind of conditional pause after that, so look for a language shift in the statement. You won't get an update to the forecast. That's not this meeting. That's the one after this one in June. So we will have a statement, look for some changes in that about communicating ultimately what's next. Futures just a little bit firmer from New York City this morning. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve appears ready to signal a pause to its aggressive interest rate hiking campaign, but not before raising rates another 25 basis points. Policymakers are wrapping up their 2-day meeting today. Tighter lending conditions and signs of a slowing economy suggest inflation will cool more in the months ahead. The UK plans to loosen IPO rules to make London more attractive as a financial center. That comes after a dramatic drop in the number of new listings in the city. The Financial Conduct Authority wants to replace its premium and standard listing categories with a single offering in a bid to attract more companies. Ukraine's President Volodymyr Zelensky is on a surprise visit to Finland. He'll meet with the leaders of Finland, Sweden, Norway, Denmark, and Iceland to discuss support for Ukraine and other security matters. Nordic nations have been among the active donors to Ukraine this year. In Texas, law enforcement has arrested the man suspected of shooting 5 people in a neighborhood dispute. Authorities say Francisco Oropesa was found hiding in a closet underneath some laundry. According to officials, neighbors complained to Oropesa and to police Friday night that he was firing a gun in his yard. The FBI says Oropesa then entered their house and killed 5 people. Eli Lilly's experimental drug for Alzheimer's slowed the progress of the disease in a final stage trial. That paves the way for the company to apply for U.S. approval. Lilly said today the drug slowed the disease by 35% over a year and a half. The company has spent billions of dollars and decades of research on Alzheimer's. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I think the fact the Fed has raised rates by such a large degree so quickly, we really don't understand yet the full ramifications of those rate increases. Now, if you take a potential or perhaps slow ongoing banking crisis and place that on top of a slowing economy, I have to say I am very concerned at the prospect of future rate increases. I don't understand why we wouldn't just pause now.
Everybody's piling in. That was Brendan Boyle, the Democrat from Pennsylvania. Pressure building on the Federal Reserve to hit pause. Well, they're about to anyway, after they hiked 25 basis points. That is the overwhelming consensus view on Wall Street right now. Looking at the price action going into that Fed decision, we look like this on the S&P. We're positive 0.2%. After that, we've got Apple earnings after the close tomorrow. Then it's on to payrolls on Friday, an ECB rate decision somewhere in between, with the euro reclaiming 110 in the last 24 hours, 110.35 on the euro against the dollar, positive a third of 1%. Off the back of yields moving aggressively lower yesterday. And again this morning, just a little bit, by a couple of basis points, Tom. Your 10-year, 339.94.
A lot of different stories here, a lot of different narratives, John. Right now, I think we've got to revisit just for the moment here. Oil, my eyes are failing me on the Bloomberg terminal, 69.40. Oil can't find a bid. It was 70 at 69.40. Do we get a 68 print here at one point? Down 3%.
Brent 73, same story, Tom.
Same story in oil. What we're going to do here is look at the politics, and I really want to focus on the gentleman you just heard from. Brendan Boyle is a different Democrat. He's a guy from really basic means, a scholarship student at Notre Dame, and of course, did well at Harvard as well. He's someone that actually understands the linkage of our monetary policy into our politics. Anne-Marie Horton is our Bloomberg Washington correspondent on this important Fed day. Anne-Marie, I want you to describe the pressures that Brendan Boyle faces. He's outside Philadelphia, I believe in the 2nd District. He's a Democrat, and he's fed up because he's seeing half of America struggling, even while the elites do well, given Fed policy. Is Jerome Powell aware of Brendan Boyle?
I think Jerome Powell is very aware of Brendan Boyle because besides Senator Warren, he was the individual that in the House led congressmen and women to sign that letter as well. He was one of the signatories of that letter you're talking about to the Fed chair that is asking them to pause, to reevaluate the data, and then wait. And what he is concerned about is not just potentially what the Fed said when they hiked in March, which is we could see at some point maybe a mild recession. They're worried about the potential of job losses, but also they're still concerned about the banking crisis. The underlying fact on all these 4 banks that have failed is the fact that they were dealing with a higher interest rate environment and they were not prepared for it. So these are some of the concerns from individuals like Brendan Boyle, the congressman there. And he was joining us actually from Milken. And this was the first time he was at that conference. And the other notable thing he said was that he is feeling and seeing the urgency about the debt ceiling drama happening now in the business community while he was at that conference.
But to me, and this is like a third rail with me, Anne-Marie, I don't mean to be personal about it, but Jerome Powell grew up fancy. Georgetown Prep, his father was a lawyer, et cetera, et cetera. You know what? I grew up fancy. Brendan Boyle did not grow up fancy. And that letter to me is a primal scream from half of America saying, look, this is the reality out there. Is this Fed, to John Ferro's piercing comments this morning, is this Fed politicized enough to listen to Brendan Boyle?
I'm not sure if I would say the Fed is politicized, but this has happened in prior Fed regimes as well. Look at what happened during the Bernanke years. You had McConnell, you had John Boehner doing the same thing, sending letters because they were worried about quantitative easing. This is what happens, but now it's Jay Powell and it's Democrats. It isn't new to me that politicians are sending letters to Jay Powell. Obviously, the height of the concerns and the criticisms about the Fed and whether or not the concerns of whether or not it was independent or not came during the Trump administration when the president himself would tweet at Jay Powell if he didn't like the outcome of those meetings and said he had no guts and said he was behind the curve in his actions. But in terms of letters from politicians, this has been happening time and time again. It just depends on the moment if it's the right or the left.
Anne-Marie, are Republicans pushing back and saying that these letters and these kinds of comments are irresponsible and fostering the chances of inflation remaining high for longer?
Well, I think what Republicans will say, what they constantly do, is they will just turn it around on the Democrats and talk about the reason why the Fed is in this aggressive rate hiking cycle. And that's because they are trying to tame inflation. And what Republicans will say is that's because of excess spending from the Biden administration. Now, obviously, there's a ton of nuance in why we have high inflation, and economists are not pointing to the bulk of that, to some of this, to all of this, to spending. But that's the Republican argument. But no one's coming out exactly, and I don't think as upset at this letter, except maybe Jonathan.
Well, but I gotta say, and John, honestly, this. But to me, hold on a second.
Pile on
no,
John
I'm not gonna say John. No, I was gonna say something else. That it feels like I can't keep track of the political spin. And you said something earlier that I actually thought was really good, which is why don't you just get the debt ceiling resolved, which is the one thing that you guys could do, rather than some of these, potential spins on all sides of everyone being wrong.
We have to call out political grandstanding whenever it occurs.
Happens a lot.
Let me read you a letter. Dear Jay, inflation is running at 8%, interest rates are still 0, and you're still doing QE. You need to hike rates aggressively and now. That was the letter they didn't write.
I was like, what are you reading
Back
from?
in early 2022.
That would have been really
what happened to
interesting.
that letter?
Yeah, but you raise a good question, which is what's their track record in terms of calling monetary policy correctly, which is true. And what's their record of being able to resolve a debt ceiling debate? Also terrible, with some sort of sense.
So Americans
of what's
are
going on.
hurting now. They weren't hurting last year when inflation was at 8%. No, they were going around saying how great the economy was.
Look, as far as political grandstanding, I think the difficult thing is parsing the signal from the noise. How do we determine what they're actually doing? And I think, to Anne-Marie, to that point, is there a sense that there is growing willingness to pressure the Fed on either side, including with appointments, to try to shift monetary policy for a political perspective?
Well, I think what you'll see, you mean appointments in terms of we're still waiting for the Fed vice chair to be announced, even though Lael Brainerd has been in her job now for a number of months. There has been a lot of politics surrounding that in terms of, we heard from Senator Bob Menendez, who continues to really urge the administration to make sure that as they are looking at the potential Fed picks, that there is an individual from the Latino community that is now on the Fed board. But again, this has happened time and time again on the right and the left. But to Jonathan's point, it is important to call out the fact that, like people in Brendan Boyle's district, if they're concerned about losing their jobs, they were also concerned about the price of gasoline. They were also concerned about the price of their rent, definitely last year.
AMH, wonderful to get your perspective. A balanced view from Washington, D.C., as always. Anne-Marie,
okay.
Thank you. On the Federal Reserve, and some political pressure building, Tom, over the last 24 hours.
It's there because we become more restrictive. To review this, we moved from Stanley Fischer's ultra-accommodative too accommodative, and I'll let everybody figure out the glide path on the path to restrictive. Dominic Constant at Mizuho would say, right now, with other things involved, we're super restrictive. But my point of this, and the political primal scream you see, and I think we observe it every day in New York, basically half the American public's flat on their back. I mean, that's all there is to it, even with a boom consumption, the airports are full, all the elite stuff that elites are doing is great, but there's a huge body of Americans out there that the Fed is not listening to. That's a fact.
It's hard enough to game out where the economy is going right now without political interference. It is hard enough to read the tea leaves, which are giving you all sorts of different signals. And it's difficult when you get political grandstanding, whether it's former President Trump coming out and jawboning the Fed, or whether it's a letter basically saying you guys are doing it wrong. There is a very difficult moment when there is a complete lack of clarity in the actual fundamentals to then clog it up with, partisan grandstanding. And I think that that is fair.
Imagine if unemployment wasn't 3.5%.
Oh.
Can you imagine?
That's the heart of the matter.
This is happening with unemployment at 3.5%.
And the chart this week of incomes of lower quintile are really pretty good, buoyant up, and it's the second, third, fourth quintile of more affluent people that are hammered.
I'm not upset, just for the record. I'm doing okay.
That's great.
I'm all right, you know.
If you have to say
decent
it,
sleep.
I'm a little concerned. Was it the ET comment? Was it the...
Quiet start to the morning. That's the good news. Your equity market positive 0.2% on the S&P 500.
What's the bad?
That's coming later.
Probably you're right.
You know, on the NASDAQ, we're positive 0.3% on the NASDAQ 100. Let's get to the bond market just briefly. 2-year yield yesterday crashing lower, plummeting, plunging more than 10 basis points after climbing. After climbing more than 10 basis points. Yesterday, it was about banking stress. Monday, it was about prices paid on the ISM. We're focused on the banks right now. Let's skip foreign exchange and get straight to these two names and start with PacWest. PacWest rebounding. It's negative by 3%. This is better. Western Alliance is negative by 3%. This is better relative to, Tom, where we were, like 15 minutes ago, 20 minutes ago.
They're bounces, and the character of it is a legitimate bounce. It's not like it's breaking through a set of lower highs. Technically, what you can make of it in early morning trading is there. But, all in all, there is the faith there that we can follow on and leave FRC behind. I'm not so sure.
I'm not sure we can. Yeah. Lisa, just going through the names, I know you're looking at the same thing. It's been First Republic. It has been SVP, Signature Bank, Silvergate, Credit Suisse. You can take your pick, and we just seem to be moving from one name to the other. And I've seen a lot of commentary this morning. I think it was Evercore that used that phrase, speculative attack. It was almost like moving the shorts from one name that's gone under and just throwing them over to the next name.
Basically just trying to find the next potential contender. You mentioned PacWest and Western Alliance and how much they've clawed back. One that hasn't fully clawed back is Metropolitan Bank Holding, which I had never heard of before yesterday when I was looking at the plunge that we saw there. Those shares still lower by almost 6%. What I find interesting is the small banks you're seeing really pummeled. You're seeing much less action in the medium-sized regional banks, and certainly in the biggest U.S. banks. There is a clear delineation. The smaller, the worse. The bigger, the better. If you take a look at the mid-sized regionals, the biggest, you could see U.S. Bank basically doing better. Zion's actually up 0.4%. Comerica down just 1.7%. Nice. And PNC down 0.6%. So not a lot of action there, which I think is interesting, that distinction really coming through the market. And then when you see the biggest banks, you can basically say that the shares are all but flat, even after some of the really big gains that you've seen. JP Morgan shares down just 0.2%, Bank of America less than that, and Citigroup unchanged. So this really is focused on the smallest banks looking for vulnerabilities at a time where their model is fundamentally challenged by higher interest rates, deposits going out, and potentially credit risk into a recession.
Much easier, of course, with hindsight to identify the towel, but we did talk about this. The fact that on Monday it looked like we had a resolution for one bank, and KRE, the regional bank index, that ETF that everyone's following at the moment, didn't rally, can't get off the mat. It's still just sort of stuck down there near year-to-date lows.
The profitability question, and you put it well before when you were saying it's the return of capital, this question of safety. Okay, that might have been saved, but now it's return on capital with people just simply going into CDs or whatever else could offer them yield. You get that, and all of a sudden it restricts lending. And then all of a sudden, that's the credit impulse, and the economy slows, and, you pile it on, and it becomes a problem.
It's really basic stuff. You've got assets giving you 3%, and you've got to pay up 4-5% for your liabilities, so your funding's gone up, your profitability's gone down, and that becomes a bit of a cycle. That's an issue, just to make it very, very clear.
First thing I looked at this morning, old school 3-month LIBOR. There's other things Ira Jersey would look at, but we continue to grind higher with a higher interest rate. I did note on the PacWest website, a 13-month CD, 5.05%. So you say to yourself, well, that's pretty attractive. I can get that other places maybe, but in this digital world, the mystery to me and the clarity that needs to be provided is where are deposits? Where's money moving?
Let's make it super, super simple. If you're waking up, you're driving to school with your parents and they're forcing you to listen to this. Let's say Bremo's running a lemonade stand, $5.
Parents do that?
I'm running a lemonade stand, $5, except Bremo's lemons are free, right? And mine are going to cost more than I'm able to sell them for. That's kind of a problem.
That basically, you want to invest with my stand, and yours is going to basically go out of business in 2 minutes.
Right? That's the issue. And that's the issue.
My problem is
JP Morgan does not have to put up rates. They don't. They just don't right now. They don't have to offer 3-4% to attract deposits. They're just sort of coming over.
Yeah, my lemonade's better.
I mean, that's the disintermediation.
Carry on.
That's a disintermediation that Ken Leon was talking about. I would point out the lemonade stand analogy is really good for the parents, and the kids are sitting there reading, Meltzer, Federal Reserve history in the backseat. Our moment of silence, please, to all the children being forced to listen to us. On Bloomberg Radio worldwide, right now, one of our favorite guest joins, Mark Cabana, is with the Bank of America in global research, head of U.S. rates. So, Mark, I want to go to one spread that is an historic moment. I want you to explain to mere mortals at the lemonade stand what you see in a 3-month, 10-year spread, the T-bill as compared to the benchmark, at a negative 182 basis points, well outside 3 standard deviation move over 3 decades. Translate what that means to mere mortals.
Yeah, so what that means is that the near-term path of monetary policy is going to be well above where it is expected to prevail in the longer run. In other terms, monetary policymakers are going to set policy in a tight position in the near term, and then they're expected to go back to a more normal and lower rate level over time. That is the clear sign that we're seeing from the inversion of the yield curve. And as we all know, that's exactly what the Fed is trying to do. They're trying to set monetary policy in a reasonably tight position, slow the economy, and get inflation under control.
I jumped through some Bloomberg technical hieroglyphics today, Mark, to try to find where the normalization is, this idea of a faith in that we get back to normal. What metric do you use to describe where normalization clicks in? Is it the 10-year yield? Is that the right way to look at it? And at what level then of 10-year yield do we say normal for the banking system?
Yeah, so what we really look at is where the rate cuts that are priced into the front end of the curve really begin to decline and bottom out. And what we see is that it's right around 3% or so right now. Another way to look at it, if you're using Fed funds expectations and you want to look in forward space, is 5-year OIS. 5-year OIS is also right around 3%. And that's where the market thinks that the Fed's neutral spot will be right now. That's where they think they're going to ultimately stop cutting. And then when you think about what that means for interest rates, you can add a spread or take away a spread in relation to where that neutral rate position will be. For us, we think that the 10-year is going to be at 3.25% at the end of this year and probably remain around there in the medium term. And that's due to a Fed that's going to be setting policy somewhere close to 3%. And then you're going to have a little bit of term premia or treasury cheapness in relation to where monetary policy is likely set over the medium term.
Mark, you sound so calm at a time when people are saying things are breaking and they will only continue to break as we get further into this cycle and the lag effects take hold. How do you push back and say, actually, this is all normal? What we saw in a couple of regional banks, maybe don't use the I word, but it's endemic for what's going on, but it's not necessarily systemic. And how much are we going to see some sort of fissure cause the Fed to have to retrace their steps in a way that perhaps doesn't reflect a real fundamental improvement in the inflation backdrop?
Yeah, well, I think one can be calm when talking about the shape of the curve. But when you think about what's happening in the banking sector, what we've been saying is that there's still signs of stress. Those signs of stress have stabilized to some extent, or at least the rate of change in terms of the stress that's out there is not necessarily getting as appreciably worse as it had been. But there's still signs of stress that are out there. And those signs of stress, we think, are very clearly evidenced by the emergency Fed lending that is still happening. They're evidenced by the acute borrowings that we have seen from the Federal Home Loan Bank system. And they're also evidenced by some of the outflows of deposits that we have seen into money market mutual funds. So those things still indicate that the overall level of stress in the banking system is high. It's just that we're not seeing the rate of change on that materially increase. It's been slowing down recently. And again, this is a byproduct of tight monetary policy. It's a byproduct of the Fed that's setting policy in a restrictive level. That's what the inverted curve is telling us. And it's also then causing banks to face profitability challenges. And that's what the market is very focused on today, just like the lemonade stand analogy that you were using. It's costing banks a larger amount in order to hold and retain deposits. The Fed is set policy in a place to facilitate this in hopes that it will ultimately restrict lending, and that tighter lending will ultimately help slow the economy and get inflation under control. So what we're seeing in the banking system is very much a function of what the Fed is doing in its overall stance of monetary policy and what the yield curve is essentially confirming to us.
Yeah.
And that is that policy today is expected to be more restricted than it will prevail in the medium term. That is unfortunately causing issues for banks.
Is it a mistake for the Fed to hike rates for 25 basis points today when you're already seeing the lag effects take hold and you're already seeing stress, and this might actually complicate their ability to hold rates high for longer?
Yeah, so we think that what we're going to get today is a cautious hike from the Fed. It's going to be a Fed that says, okay, look, we've delivered upon our dots. We remain data dependent, but they're going to open up some optionality, we think, for the next move to be a hike or a hold. We expect that the rates market will hear today from the Fed, a Fed that is essentially signaling that the base case from here on out is a hold. And the onus is really on the data to disprove the hold. And we're going to likely hear that just through more cautious sentiment from Powell in his press conference today. So is it a mistake for the Fed to do this? Probably not, given that this is what they've been signaling through the dots and given that the economy still has a heck of a lot of momentum. But will it be a mistake for the Fed to be blind to the other cracks that they've seen in the banking system and some signs of slowdown in the economy? Yes, that would be a mistake. And we think that the Fed recognizes that, and they are therefore going to provide optionality in terms of their next step. And that's what the market's going to hear today. It's going to hear a Fed that doesn't know if the next move is going to be a hike or a hold, but probably that the onus is on the data to now disprove the hold, because that's the base case.
Interesting. Mark, thank you, sir. Mark Cabana of Bank of America, going into the Fed decision a little bit later. I've got to do three things. Here's one. Some people wondering, $5 for lemonade. It's an affluent suburb in Silicon Valley, just to make that very clear. Kyle writes in on Twitter. It's expensive,
Come
right?
on.
Kyle writes in on Twitter. These kids are crushing it. He says, my 6-year-old is one of those poor kids stuck in the car listening this morning. Kyle, we're sorry. I want to get to the banks as well. That's my number 2. So let's get to that. PacWest has actually turned around. So it's now positive by 5.5%. Western Alliance is positive as well by 0.9%. And the third one, this is the serious one, this headline crossing from Interfax just moments ago. The Kremlin was attacked by a drone last night. Just a little bit more information on that. The Kremlin says it was attacked by 2 drones last night. The president, the Russian leader, we're told, is safe. I'll get you an update on that when I get more information. From New York City coming up, Betsy Jew, the former Fed governor, on this Fed decision day.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Federal Reserve is expected to deliver its 10th consecutive rate hike today since March of 2022. Another quarter-point raise is anticipated and possibly the last in this cycle, with tighter lending conditions and signs of a slowing economy pointing to cooling inflation. That decision will be announced at 2 p.m. in Washington. The U.S., Europe, and other Ukrainian allies want to close more Russian sanction loopholes. The plans will be unveiled at a G7 meeting this month. Multiple rounds of sanctions and other economic penalties imposed on Moscow since its invasion of Ukraine have battered Russia's economy, but they haven't delivered a knockout blow. The price of oil plunged for a second straight day. West Texas Intermediate fell under $70 a barrel, while Brent dropped below $75. The prospect of a U.S. recession is weighing on the outlook for demand, and investors are turning away from riskier assets. Drug overdose death rates involving fentanyl more than tripled in the U.S. from 2016 to 2021. Now, fentanyl is a synthetic form of pain-killing opioids like morphine. It's a cheap, abundant street drug whose use became more widespread during the isolation of pandemic lockdowns. And shares of Starbucks are falling. The coffee chain operator left its guidance for fiscal 2023 unchanged. Analysts called it a conservative stance given the strong second quarter and sales beat. They said it suggests that Starbucks' growth will weaken in the second half of the year. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
I would prefer to do what's called a hawkish pause, not raise, but signal that we're in a tightening stance, because I actually think the banking situation may well be more serious than we currently understand it. I think we're in the early stages, not the late stages of this banking situation. We've just seen the first phase of this, which is the asset liability mismatch, which is sort of the most obvious issue, but the credit issues are about to start.
Brilliant exchange yesterday evening with Robert Kaplan, the former Dallas Fed president, and our colleagues here at Bloomberg TV and on Bloomberg Radio. On a situation at the Federal Reserve, the Fed decision just around the corner. We're looking for a 25 basis point interest rate hike from the Federal Reserve and potentially communicating a pause thereafter. Perhaps we'll see some of that in the statement. We may well hear some questions on that in the news conference too. Mike McKee's coming up a little bit later. I'm looking forward to catching up with Mike going into all of this. Here's the broader equity market, the price action this Wednesday going into Fed Day. We're positive 0.2%. I can tell you earlier on this morning, following the big losses for PacWest and Western Alliance, we had more losses. They've turned around since, just about positive on Western Alliance this morning. PacWest now up big time. I mean, it's up 7.8%. Tom, in the pre-market after being much, much lower earlier in the session.
What is this? I mean, this is basically a penny stock trading like that, and it sort of shows you the dynamics behind the scenes. It's not exactly driven by fundamentals or anything concrete, but perhaps, people trying to drive a narrative.
Feeds on itself, doesn't it?
Exactly.
One of the narratives. Where are we on the Russian headline very quickly here before we get to Governor?
I haven't got an update since
we don't have an update. We just have essentially
we
have a dearth of information.
Right now, the headline that I have for you, Tom, is that the Kremlin says it was attacked by two drones overnight, that the president, the Russian leader, is safe. That's the only information I have. I think we probably need a little bit more detail on what that word attacked actually means. Yeah. And we don't have any clarity on that.
Our team is working on that in London, and we'll have much more as we go through the morning. Right now, and this is a joy because this is the person to lean forward to on small banks and the Federal Reserve System of America. Elizabeth Duke is a former Fed governor. She is a former chair of Wells Fargo, and far more importantly, in the middle 80s, was at the Bank of Tidewater. We welcome the gentle lady from the Bank of Tidewater as well. Betsy, you lived the 80s banking crisis. Is there an analog here? Is there a similarity to what you and Isaac and McTeer went through?
So I think the situation with the banks today is much more similar to the savings and loan crisis than it is to what happened in 2008. So I think that's a good analogy, but I don't see it getting nearly that bad. The savings and loan industry got caught flat-footed because prior to that, deposit rates had been capped. And their business model was to make long-term mortgage loans. So when the cap came off of interest rates and Volcker started raising rates, the savings and loans ended up upside down. Those that, so some of them had an earnings problem. Others decided they would solve the earnings problem by going out and loading up on high interest rate commercial real estate mortgages, and they ended up with a credit problem. I just don't think it's that widespread in the banking industry today.
So, Betsy, do you agree with what we heard from Richard Kaplan, that this is just the beginning and that there is going to be significantly more distress, or do you think that it's more nuanced than that?
I think it's much calmer than that, actually. I think what happened with Silicon Valley and with Signature is that the FDIC and the regulators got caught flat-footed. They just weren't expecting it. But they have recovered, I think, really well. If you look at First Republic over this weekend, that, except for the size, that was business as normal for the FDIC.
At this point, Betsy, do you think that the risk for the Fed is not moving enough, not hiking enough, or perhaps discounting some of the weakness that could just be the beginning of what we will continue to see with the lag effects taking hold?
So I think, first of all, I think the Fed has a better sense of what's going on within the banking industry. So they have a better sense of how many potential concerns there are out there. But the bigger issue for the Fed has been convincing markets that they're serious about inflation, that 4.5% inflation is not acceptable. And so I think the Fed has to be careful not to signal any movement toward this rate cut that the markets are expecting, that the Fed continues to say they don't see.
Betsy, always wonderful to hear from you, particularly given your experience at the Federal Reserve. Next week, we've all been waiting for this release of the Senior Loan Officer Opinion Survey. Betsy, when you were on the Fed, do you have advanced information of what is in that report? Will they know basically what's going to be released next week when they meet today?
I don't. If it's a week from today, I don't think they'll have it today. But the SLOOS is a very, very soft data point. It sort of tells you, directional, but it doesn't give you any hint on magnitude. So I think it will give them some information, but I'm not sure that will be enough information. I haven't seen any clear signal yet that tightening of credit is doing any of the Fed's work for it.
Where would you look for that signal then, Betsy?
Start to look for it in consumer credit tightening up, possibly, and particularly some of these lenders to consumer credit. So the fintechs or the non-bank mortgage companies, if you start seeing stress in those companies, that's where I'd look for it.
Betsy, there's a bank out there called the Bailey Building and Loan, and it was something you and I studied carefully. I think you were at Old Dominion when you studied the Bailey Building and Loan from It's a Wonderful Life. They didn't have cell phones.
Don't age Betsy. You're talking about yourself.
No, well, yeah, that's true. I'm talking about myself. But the answer, Governor, is the basic idea here is they didn't have cell phones in their hand. How does the behavior of the Bank of Tidewaters of 2023 change given the digital media? You didn't have to live with that.
The panic is still the same thing. And if you go back to the savings and loan crisis, before one of those institutions closed, it was pretty well telegraphed that that was an institution that was in trouble. We took over some branches from a failed thrift. And it was remarkable to me that some of the uninsured deposits had actually stayed, even though it was pretty obvious for years that the institution was in trouble. So the smaller banks, their deposits are really pretty sticky. And what's happened as the Fed expanded its balance sheet, overall bank deposits grew enormously, grew much faster than loan demand. And so banks were stuck trying to balance excess deposits. What you're seeing now, a lot of what you're seeing now is the natural flow, although it's happening quickly, back from bank deposits into money market funds and that sort of thing.
Betsy, one of our themes on the show today, led by John Ferro, the gentleman from Britain who was stunned at the political input
not stunned.
into the Federal Reserve System.
Not stunned.
Not stunned?
Don't mischaracterize.
Okay, excuse me.
Not stunned. I think it's irresponsible.
Okay, well, let's talk about the irresponsibility here. In Greenspan, we were looking at which sandwich he was eating on Fed Day. Now we've got politicians of both persuasions weighing in. Should they?
No, the Fed has always been just absolutely resolutely non-political. But the political forces are always out there with opinions on what the Fed should do, whether it be in supervision or regulation or monetary policy. I think the political environment has more to do with the regulatory and supervisory policy and how they react than it does monetary policy. I've never seen any, in my experience with the Fed, any reaction to political pressure on the monetary policy side.
Betsy Duke, thank you. It's good to catch up with you, as always. Let's do this again in June ahead of the next Fed decision. I always know when Bramo's got things to say.
Yep.
I'll assume the position.
Yep.
You describe it on radio.
Yep. Lean back. It's like a David Brinkley lean back, but the arms are crossed.
I know I'm not on camera. So.
Not to the face, because then it's like.
And on radio, it's called the Chicago tilt. You go like this.
I've got.
Okay, hold on.
There
this
we
is
go.
what I was thinking about.
Things to
Okay,
say.
and I am wondering whether economics as a profession has become more politicized, with people on one side having a bent toward one thing and people on another side having a bent toward another thing. So to say that there's no political interference is a difficult distinction to draw.
Have you ever met Stiglitz?
But this is my point. Aside from just if you know something to be one way, but it's almost like in the legal profession. There is a conservative school of thought, the idea of originalism in this sort of federalist society versus the idea of a living document, et cetera. There is a similar kind of dissonance within the economics profession where there is a political bent to some of the opinions. And so I wonder how we can parse that out. That's what I was thinking about.
I would suggest
Thank you.
I would suggest the long-term moving average of GDP in the nation has declined some 30% from 3.x% down to 2.x%. And that angst, John, is the political debate.
We've all got one question for you, sir. Who's Mr. Potter?
Mr. Potter?
In your Bailey Buildings and Loans analogy.
He didn't want to give out toasters.
Of the modern era. Who is that, TK?
Well,
we want to know. Inquiring minds.
E.T., Mr. Potter, who's next?
Rates are going up. Inflation is still high. and the economy is clearly weakening.
I don't think there's enough real growth for everything to work.
What if the Fed really doesn't start cutting? What if they just pause and hold?
As we go later into the year, the Fed will not cut. They will not cut if there is a recession. They will not cut if there is banking turmoil or financial market turmoil.
If the Fed were to lower interest rates these days, certainly you would get some inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television. It is a Fed day, and yes, we'll be with you at 2 p.m. This afternoon. We start at 1:30 this afternoon, and all wrapped around this Fed decision, John, is what are they going to do on rates? No, it's the verbiage. It's the dialogue we'll hear in the press conference.
It's the statement as well. So it starts with the statement in the third paragraph, and this line right here. The committee anticipates that some additional policy firming may be appropriate. Will the 25 basis point hike today be the additional policy firming that they were indicating at the last meeting? Will that stay? A lot of people think it goes, Tom, and they communicate a conditional pause. We'll find out at 2 p.m. Eastern Time.
And it's a Fed that has to sum in the aggregate of all of our macroeconomics, all of our society into one decision. And yet there's some real tension here now that we are somewhat restrictive of the haves and the have-nots at this meeting today.
Lisa asked the $1 trillion question earlier on in the program. What data? They'll say we're data dependent, and we've got to ask what data are they dependent on, as well as how reliable is that data right now. So when they discuss the totality of the data, are they talking about what's happened with PacWest and Western Alliance yesterday, those stock moves? Are they talking about that, or are they just talking about traditional indicators, CPI, the labour market, all of that good stuff, Tom?
Lisa, I got to believe they're going to go back to the labour market. Oh, we have the ADP report here in 14 minutes. It's the beginning of what we see on Jobs Day after the Fed. But as we've mentioned earlier, sub 4% unemployment rate, that's not a troubled America.
It's not. It's also a deeply lagging indicator at a time when faster moving indicators like the JOLTS data that we got out yesterday are indicating some loosening, some slack in the labor market akin to what they were looking for. So at what point do you wait? I mean, you were talking about this early, Tom. At what point do you wait to see what the effects are before making another move? Or can they not afford to because of what we heard from Victoria Fernandez, that inflation is still the preeminent concern?
Inflation is still the concern, and we're not done. We're going to get more data on that, but I would fold it into a global view, as we heard from Bruce Kasman of J.P. Morgan. John, you've centered, as you do, John, on the ECB. Lisa and I think are pretty much removed from that, but they're all in the same conundrum of trying to game out their ex-post view given present angst in Europe. Look at the inflation numbers in Europe versus here. They're
But then compare that
stunning.
to the Eurozone bank lending survey, where things look pretty tight. Now, Tom, to your point, do you want to act ex ante or ex post, before or after the fact in that world? If you can see it in the pipeline coming through, and clearly the Federal Reserve's trying to play something in between by having a little bit of a conditional pause. Citi don't think you get that pause, by the way. Not everyone thinks you will.
The pause today.
Andrew Hollenhorst thinks 25 today. He thinks 25 in June. He thinks 25 in July. And he thinks, Lisa, by the time you get to June, they put out new forecasts. They'll be revised higher, not lower.
And yet, on the other side of this, I think a lot of people do agree with the inflationary push. On the other side of this, you have auto manufacturers that are actually cutting prices to compete. You have this idea of how much disinflation is coming in as people push back against pricing, where it is. This is the push and the pull.
You know, I'm going to go even more micro on you. Taylor Swift did 2 nights in Las Vegas, and with her pricing power, she got them back to some form of pre-pandemic equivalency.
She's
I think
her own
every
PCE
industry, the microcosm here, between John Lawler at Ford, the CFO, we're going to talk to in moments, and Taylor Swift. I mean, these are all individual stories. You know what? Jerome Powell doesn't care. He's got to look at the aggregate. And as Victoria Fernandez says, John, how do you get from 4% inflation to 2%? That's the challenge.
You'd acknowledge that Swift is a Veblen good, wouldn't you, TK?
Very, very Veblen.
Right.
Yeah, she's very Torsten. Ask Fernando Alonso. Thank you to Aston Martin yesterday for
Swift
that moment.
tickets, to be precise. So, anyway, carry on. Let's not get in trouble. I just got a message from a Bloomberg terminal subscriber that just said this: Tom is Mr. Potter. That's what it said.
Good, we've established that.
TK is Mr. Potter.
Mr. Potter's looking at a gallon of gas, which was 8 cents a gallon back when they made the movie. Right now, John, I'm looking as to begin the data check. American oil under $70 a barrel. What does that say? I mean, it's going to $100, John.
First time
it's going
since
to
March.
100.
Well, we're not getting there, are we? We're breaking down. First time since March, below 70 on WTI, below 75 on Brent. Those numbers started to come through through just a little bit earlier in the session. If you're looking at the broader market on the S&P 500, futures positive 0.2%. Yields look like this on Treasuries TK. They're a little bit lower on a 10-year, down 2 basis points. Just a little break of 340 this morning, going into the Fed a little bit later.
Well, right now we're going to dive into what's happening in that big part of the auto economy. Ford Motor. John Lawler is the Chief Financial Officer of Ford Motor and joins us this morning. Off of earnings, Day and Reese over at Bloomberg, John, their headline is Ford dips as lack of outlook sparks concerns. Give us the immediate outlook for Dearborn right now. What do you see in the next 90 days?
Well, just looking at our Q1 results, they were solid. Good quarter. 20% top line growth, solid adjusted EBIT at $3.4 billion, and we held our guidance between $9 and $11 billion for the year from an adjusted EBIT standpoint. Look, I think all of us can agree that it's unclear how the macroeconomic environment is going to unfold through the year. There's lots of puts and takes that we're seeing as we work through the rest of the year, and so with a good, strong Q1, but a lot of road ahead of us this year, a lot of puts and takes on a macroeconomic standpoint. Traditionally, what hits this industry, we held our guidance. So, we're comfortable with that. We think it's appropriate at this point.
It's extraordinary, the auto business, how separate it is from, say, Apple Computer tomorrow with a 25 multiple. You guys are doing single-digit multiples with a 5% yield. Is there any pressure on you as a CFO to adjust your auto company to a modern cash distribution that makes you more competitive within the markets?
Look, there's a great opportunity for us with our Ford Plus strategy and where this industry is heading with connected vehicles, software, and services on top of the traditional products that we've delivered, from the automobile standpoint. So we see that as a positive. We know that in this industry, what we need to do, and our focus is on really strong capital allocation, making sure we're getting returns on that capital, quarter-over-quarter performance, and that's what we're focused on.
John,
that's going to change the multiple for us.
How complicated is it for you that Elon Musk is cutting prices at a time when you're already losing $3 billion a year on your EV effort?
So I think, you got to think about this as where you have pricing power and where there's competition. You can't paint the segment with a broad paintbrush. Look, on the Lightning, incredible demand. Our order banks are off the charts. So from the F-150 Lightning electric vehicle, we have pricing power, and that's maintaining. Our electric transit van, there's pricing power there. That's maintaining. Where we're seeing competition is in the two-row crossovers, and we've been consistent over the last few quarters that there's going to be competition there, and that's going to cause some pricing pressure. It's natural. So, we deal with it, and we're focused on cost reductions. We're focused on providing good value to those consumers, and we'll compete in that segment.
How much is this competition, and how much is just lack of demand?
Well, I think you're seeing, as an industry standpoint, we've had an imbalance between supply and demand, right? We were constrained due to COVID and the issues with supply chains. You're starting to see that ease, so you're starting to see more supply come online. Therefore, we're getting more into balance, and you're seeing some pricing pressure on the top line.
Provide me with the distinction, not only within your good competitor in Detroit, but the distinction of your EV approach versus others worldwide. What is the Ford unique feature on electric vehicles 5 years out?
Okay, so when you look at our approach to EVs, I think it's as good as anyone's and better than most. We were a first mover. We're in the marketplace. We're bringing customers into Ford. EV customers are not loyal at the first purchase, but once they purchase a brand, they're loyal to that brand. 60% of those customers are new to Ford, and now we're on our second generation of design. Everything we've learned from our first generation, much more competitive from a cost standpoint, much more focused on what the customers value, and I'm really excited about what I'm seeing in our second generation of EVs, and in fact, the start of our third generation of EVs. So I see us being very, very competitive as we move forward.
As you try to be as efficient as possible, John, you've talked about cost cutting. How much does that include job cuts that hadn't already been announced?
So look, we can't just look at this as job cuts. We have to focus on, and good companies focus on all cost areas, and we're going to do that. But in this transformation and what we're seeing here in the industry, there's going to be parts of our business that need to upscale and grow, and there's parts that need to, reduce. And that's going to be part of our focus as we go forward.
All right, we're looking for tickets, John. John Farrell, help me out here with John Lawler. I mean, you're going to do a relationship with Red Bull and Formula One racing. John Lawler, are you going to be in Miami for the Formula One? I believe it's this weekend, and can we come along?
Unfortunately, I'm not. But if I were, I'd be happy to host you.
There we
go. But I'm not
going
to be there.
There we go. You can come back next time. John Lawler of Ford. Thank you. What was the car you and I saw at the weekend? What car was that on Saturday? That big EV. What was that? Hummer?
It was huge. It was a Hummer.
EV.
It was a General Motors product. It was a Hummer. John Tucker has one.
It was ridiculous. And I think we both walked out of this bar, Bramo, and we both started laughing. And we both said to each other, there is no way that's environmentally friendly. What are we talking about here?
This was in Washington, D.C., and I saw a number of those in Washington, D.C., because they're politically correct, but are they?
This one was bright red. Tucker's is black, but,
to your point,
they're huge.
What a great point. Is it just about being politically correct? When we talk about EVs, a new source of energy for automobiles and all of that stuff, and we're always talking about how environmentally friendly they might be, are they that environmentally friendly when you're building them in that size?
Well, no. I think that you could pretty much say no. I mean, I don't think that anyone could argue that they're environmentally friendly when they could be a smaller car, because they should just be a smaller car. I mean, that's the whole point. As far as the EV environmentally friendly argument, it's a complicated one, and I think people are trying to game out the studies of what it also takes to get the palladium, the copper, the other things out, the cobalt out of the ground. But then if you could recycle it perfectly, then it becomes more of maintenance and ecosystem.
She's very green there.
Super green.
She's super green.
Super green.
That's what counts for super green on this show.
Super green.
Yes,
that's amazing.
That's super green. That's how sad it is.
It's super green. Well done, Bramo.
Anytime.
Lee Ferridge, State Street's coming up. Looking forward to that conversation. Your equity market positive 0.2% on the S&P 500.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Russia says it defeated an attack by 2 drones on Vladimir Putin's residence in the Kremlin last night. According to authorities, the drones were disabled and crashed without causing any damage or injuries. Russia blames the attack on Ukraine, which isn't commenting. The Federal Reserve appears ready to signal a pause to its aggressive interest rate hiking campaign, but not before raising another 25 basis points. Policymakers are wrapping up their 2-day meeting today. Tighter lending conditions and signs of a slowing economy suggest inflation will cool more in the months ahead. The UK plans to loosen IPO rules to make London more attractive as a financial center. That comes after a dramatic drop in the number of new listings in the city. The Financial Conduct Authority wants to replace its premium and standard listing categories with a single offering in a bid to attract more companies. The price of oil plunged for a second straight day. West Texas Intermediate fell under $70 a barrel, while Brent dropped below $75. The prospect of a U.S. recession is weighing on outlook for demand, and investors are turning away from riskier assets. And Eli Lilly's experimental drug for Alzheimer's slowed the progress of the disease in a final stage trial. That paves the way for the company to apply for U.S. approval. Lilly said today the drug slowed the disease by 35% over a year and a half. The company has spent billions of dollars and decades of research on Alzheimer's. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The ADP report does not confirm the gloom. Mike McKee joins us now to break it down. Morning, Mike.
Good morning, John. Well, just to throw something else into the stew out there, we've got a strong jobs creation number from ADP. Whether it translates into the National payrolls report is another question. 296,000 jobs created, according to the automatic data processing people, during the month of April. 67,000 in goods producing, although most of that comes in construction and natural resources mining, oil drilling, shall we say, because manufacturing loses 38,000 jobs in their report. 229,000 in service-providing jobs. Of those, 154,000 are in the leisure and hospitality category, which, as we know, is still struggling to find workers. They do a pay report now, of course, and it does show some bit of a slowdown. Median pay change 6.7% for those who are in the job staying category. 13.2% for job changers. Those are down from in the sevens, the job stayers one, in previous months. So the question is now, what does it look like for Friday for non-farm payrolls? The ADP report is only private sector jobs. The forecast on the Bloomberg survey for private sector jobs is 151,000. We'll see if that is what they come up with for the month. They have been, guys, in the last couple of months below what the national payroll numbers have been. So it'll be very interesting to see if the national payroll numbers are strong.
Mike, stay close. I know we're going to catch up with you again in about 12 minutes' time. Mike McKee down in Washington this morning for good reason. This afternoon, the Federal Reserve decision. Mike McKee will be in that news conference. He'll be with us on the programme as well to break down that decision. Looking ahead to payrolls on Friday, 180,000 is the estimate so far in our survey. This number from ADP, 296. And I have to say, the market really didn't move much on it. Equity futures near session highs with positive 0.3%. Yields were a little bit lower this morning. They're now higher by a basis point on a 2-year. Still sub 4%, 397. Just to move across from the bond market into foreign exchange. That increase in yields really not doing much for dollar strength. Euro still stronger, dollar still weaker. Bit of movement, Tom, not much.
Yeah,
the Euro 110.34.
Yeah, I like that analysis. I think on a correlated basis, there's, like you say, a bit of movement. I got to admit, I go to West Texas Intermediate, is the stagflation, stagnant recession statistics, $69.65. That's a little bit off the bottom here as well. Right now, to sum this up and to frame out to where we are this afternoon, in our special Fed coverage, Lee Farage joins us, head of macro strategy for North America at State Street. Lee, I want to go to one adjective you have, which is sticky. And this is the heart of the matter for Jerome Powell, the level and the character of sticky inflation. Define sticky as the chairman sees it.
Not coming down fast enough, Tom, it basically. And not just that, if you look at 3-month annualized, in terms of core or in terms of headline CPI, core is headline sticking around 4%, core is sticking around 5%. It's been like that since basically November. The 3-month annualized hasn't changed. It's not coming down, and that's not a 2% inflation target.
John, this is a pro analysis. I can't say enough in times of tension how you go to 90 days and then you annualize that out. The phrase 3-month annualized is a pro analysis. It's what I do all the time, as Mr. Farage does there.
Next logical question then, Lee, with that in mind. Are monetary policy objectives in conflict with financial stability concerns?
Oh, totally. Oh, absolutely. There's no doubt about it. Inflation is still too high. It's sticky. It's not coming down fast enough. And wages are the key here. Wages are still too high. We saw that from the employment cost index. Average hourly earnings is arguably more important on Friday than the actual payrolls number. They're not consistent with a 2% inflation target. And yet, as you say, we have these financial stability issues as well. The Fed is between a rock and a hard place right now. I don't envy them the decisions.
Are you working with the assumption then, Lee, that the banking stress gets worse, not better?
Jonathan, I don't know. No one knows at this stage. I don't think it should get worse. But, we saw the moves yesterday. I don't know where those moves came from on the equity side. So, look, I don't think it should get worse from here. I think it should be fine. But none of us know. And no one can say with any sort of level of certainty how this will pan out from here. The question for the Fed is, look, do you react to the potential risk that's out there in the banking sector? Or do you react to the real risk that's in front of you, which is the sticky inflation? That's the decision they have to make right now. For me, I think you deal with what's in front of you. we can see what happens on the banking sector further down the line, but you've got to deal with that inflation issue, because arguably if you take your foot off now, then inflation stays high. That's going to make things worse in the longer run.
John was talking about the little reaction that we saw in markets to this ADP number, despite the fact that it really pushed back against some of the gloom that we'd seen over the past couple of days. Do you think that this market is biased to the gloom, is biased to believe that inflation is falling radically, and that it really is an issue of the Fed cracking the banking system more than needing to continue to fight inflation?
Oh, for sure, Lisa. For sure the market is biased to the gloom. Look, we have 50 basis points of cuts in for the second half of the year. Based on what? You know, in terms of the fundamental data, there's no reason for us to have 50 basis points of cuts in. And yet the market is biased that way. Our own institutional investor risk appetite measure, that shows that real money investors, institutional investors, have been pessimistic basically since January. It's the longest run of pessimism we've seen since 2015, and that's reflected in these market prices. So yeah, we're biased to the gloom, and every story of gloom gets a bigger market reaction than any story of positivity. And that's why in February, when the data was very strong, the market had a massive rethink. And then the banking crisis happened, and it could go back to where it was in February and go, okay, 50 basis points of cuts before the end of the year. The risk is, as in February, that has to get taken out again.
So, Leah, as an investor, how do you play that bias that you think is inaccurate?
Basically by playing the rates market and looking for rates to be higher at the end of the year than the market is pricing right now. I also like the dollar, but, you know, really what we got at the moment is this stasis. You know, the DXY has been within a 2.2% range for the last month. You look at equity markets, we're basically unchanged over the last 3 months. Some volatility in there, but unchanged. Really, you got to play it in the rates market. I think the cleanest way is to look at those year-end sort of estimates for funds and fade those moves, because I don't believe the Fed will be cutting anywhere near that amount by the end of the year.
Lee Farage of State Street. Lee, appreciate it, buddy. Thanks for being with us. Thank you very much. Going into the Fed. Coming up in the next hour on Bloomberg TV, brilliant lineup. Francis Donald of Manulife, Matt Hornback of Morgan Stanley, Troy Gajewski of FS Investments, and we'll catch up with a bank analyst from CFRA as well to go through some of the regionals, Tom.
Yeah, what's interesting here within the gloom that Mr. Farage talks about is we've come, you know, I get it. We're not positive year to date on SPX, but on Dow, we're really getting a little green in the screen every bit. So how long did it take to get back out of this bear market to break even, John? It took like, what, 18 months, 2 years? In 1972, to get back to the peak, John, it took 10 years to get back to what we've accomplished in 18 months. The resiliency here, I think, is underplayed. We're all looking at Apple tomorrow and all that and the spectacular luxury sector, blah, blah, blah. But the answer is, off of a pretty grim pandemic bear market, we've come back pretty fast. I don't think that's in the zeitgeist.
One man's resilience is another man's complacency, point one. Point two would be it's been a very, very tight, well-defined trading range through the whole year, 3,800 to 4,200 without much movement. And clearly 4,200 has been quite the ceiling over the last few months. Year to date, we're up by about 7% or something like that, Tom. I'm with you. Decent year-to-date gains, likewise on the NASDAQ, up something like 15%. But Michael Showell of Marketfield sat in that seat next to you, TK, and talked about the prospect of a lost decade at the index level, which is not unheard of in economic history, either in the United States or internationally for that matter either.
Especially as we see a real kind of fight for leadership. And we've seen a lot of those gains really derived from Amazon, from Microsoft, from Meta, and these are really the big drivers at this point, leaving a lot behind. Those catch up, the others pull back. You start to see how you could get that loss kind of muddling return picture for a period of time.
4,200. Is anybody calling for 4,300 or 4,400? There's like, what, 3 people? And they run a lemonade stand?
Well, actually, speaking of that, Limonira is the biggest producer of lemons that ship them to the U.S., I believe. And they're offering an incredible credit line available.
Thanks for that.
Do we detect a lemon stand this weekend in the island of Manhattan?
Mine is crushing it.
Are we doing this again at 1:30?
Yes, we are.
Can't wait.
With a lemon stand.
Oh, yeah, I'm sure.
Bloomberg Bloomberg Surveillance on this Fed Day. Again, our coverage this afternoon. Please tune in. Wonderful guests, and Lisa, to have Clarida and Dudley together at different moments, but to have Clarida and Dudley together is really special.
Especially get a sense of which data point is really going to be important to keep watching, especially given some of the strains that we see at regional banks.
I really want to emphasize Professor Clarida has really been controversial in the last 6 weeks on where he thinks this Fed is heading, and there'll be some careful questions there to the gentleman from Columbia. Right now, we're going to go to Michael McKee, who's looking at something I don't really care about. Michael, why do I care about this report? It's important, isn't it?
It is important. It's Treasury refunding. It matters to the people who buy the Bloomberg terminals who pay your salary, Tom. So we're going to give them the information they need, and that is that Treasury's auction sizes are unchanged for the second quarter. They are constrained by the debt limit, but they say as soon as August, they may need to increase them. This time around, the debt is going to be $96 billion in total, $75.2 for refunding, and $20.8 billion in new cash. But here's the real headline. Treasury is going to start a program of buying back older Treasury debt in 2024. This is something they have not done since 2000, when they thought we had a problem with the government surplus at the time. They would take some of the Treasuries off the market that they didn't need out there anymore. Now it's a question of a lot of these off-the-run older Treasuries, Tom, are very low coupon. And since the markets are focused on the high interest rate ones now, they are not moving very quickly, and that is causing some liquidity problems. So they'll buy back to improve liquidity.
I'm in the world of Bramo. So, Lisa, this is really important stuff. I make a joke about it, but as you're the adult in the room here, what I notice is the spread between the 3-month and 10-year yield goes out to new record inversion off of this announcement.
If you take a step back, there has been a lot of criticism of the Treasury, Mike, over the past decade that they didn't sell more debt with longer tenures given how much rates were so low. What is the pushback in terms of executing this kind of buyback program for liquidity reasons when essentially you're giving up all but free rates to just refinance at much higher ones?
Well, at this point, what happens is people don't want to trade those. They're much less liquid, given the higher coupons you get from the Treasury these days. So to improve market liquidity and functioning, they want to do the buyback program. It's a different matter from what happened in 2000. But it's probably going to be small, they say, and it is going to be weighted so that it doesn't change the average maturity of the yield curve.
Michael McKee, thank you so much. Greatly appreciate this morning. And to go through the levels here, the 2-year yield all over the map, now flat, 3.96, just below 4%. And the 10-year yield in 3 basis points, 3.39%. The vanilla spread, negative 56 inversion, 56 basis points is not unusual. But, folks, again, I'm going to go to the 3-month 10-year to show the tension of the moment into this afternoon's meeting. 103 stunning basis points on the difference in yield between the T-bill and the benchmark note. Somebody that has this tattooed to their brain is Jonathan Pingle, chief U.S. economist at UBS, with yeoman's duty, working for the Fed in the macroeconomic section as well. Jonathan, take us inside the Fed today, where there are 300 PhDs like you, your work at Chapel Hill, but take us inside what 300 PhDs will advise the board, the governors, and ultimately the chairman.
Well, I mean, they have two tensions on the staff, right? I mean, in the last, projections prepared for the FOMC, they did put a recession in their baseline. They also will have collected for this meeting the latest senior loan officer opinion survey. So they will be getting, real-time feedback on how lending officers are thinking about the potential credit tightening, in the wake of the recent events in the banking system. But even given those downsides, they still do have an inflation problem. So I'm sure the staff is advising them they need to follow through with one more rate hike. They're not out of the woods, or they're not out of the inflation woods yet. But that there are certainly downside risks that they need to consider for this decision.
On a theoretical basis, how original is the territory the chairman traces this afternoon at 2 p.m.? Is this like business as usual for you in the textbooks, or is it just absolutely original how he needs to react?
Oh no, this is really, really new. I mean, the problem that they face, I mean, it's very different from what they faced in the 70s. They've got a lot going on with the tensions in the banking system. And we saw that on Friday in the Fed's own report on their review of SVB. I mean, they talked in that report about the actions they could take to intensify the supervisory regime for a wider range of banks. And they said in the report that these changes that they could make without legislation, would be a burden and potentially a burden to credit intermediation. So the Fed's very aware that, what is going to unfold, risks a tightening in lending standards over and above what the rapid recalibration in rates, might imply. And at the same time, they still have this sticky inflation, which, you all have been talking about. And we're looking ahead to sort of next week's CPI, expecting, another relatively strong gain. So, they still do have this inflation problem that they need to address while they balance it against these other downside risks. And I think it really presents a tough task for the chair.
Do you have a sense of just how much of the lagged effects, how much of the hikes that we have not yet seen percolate through the economy, percolate through the financial system?
Yeah, we would estimate you're actually probably not even halfway done in some sense, right? I mean, if you went back and you looked, just take the Fed's, Furbis coefficients that they've published in the past. I mean, the second 12 months often in these estimates has a bigger impact than the first 12 months. So there still is this, lagged effect that we expect to mount over the coming year. So I think in the FOMC statement, when they say that they're considering the lagged effects of monetary policy, I think they mean it, and there are still lagged effects to come.
One of the big challenges is the just incredible difference between people who believe we see a structural increase in inflation going forward based on deglobalization and an aging population, and people who say it's quite the opposite, that with the debt overhang, it's a weight on inflation that brings it low to where it was before the pandemic. Which camp do you sit in, and how do you determine what's right?
Yeah, I mean, it's going to be impossible. We'll all know in 20 years, and there's going to be a lot of dissertations written about it. But, when we look at either the cross-section, to us, population aging is disinflationary. Now, deglobalization, that has been disinflationary. And if it really goes into reverse, we estimate that would push up inflation. But the magnitudes that we estimate aren't particularly large when we do these decompositions. So when we think about what's unfolding with inflation, we're looking at, basically households still have low inflation expectations. If the Fed succeeds in slowing the economy, taking some of the steam out of the labor market and nominal wage pressures, we do think that even with some of these structural tailwinds pushing inflation higher, that you can restore price stability here.
Jonathan, you and Lisa go right to where I wanted to go, and I was researching this as well. I want to go like back when you were at the Fed, and I'm going to pick on Chad Fulton with 3 degrees from the University of Oregon, and he's in the prices and wages section. This is buried 14 floors below the Echo building, like they get warming from the inner core of the earth. They're buried so low. But John, this is important. Here's a bright PhD telling the chairman and the team about prices and wages. Olivier Blanchard would suggest there are these other factors dampening our STARD, dampening the world. But as you say, we're not going to know for 20 years. So what is a Fed to do with those other factors that Chad Fulton and Olivier Blanchard are studying?
So I think Chad's actually on the 3rd floor, which is where we were in the labor and macro bay too. But to be fair, Chairman Greenspan once said that uncertainty was really the central challenge of monetary policy. I mean, it is really all about, having to make decisions with an uncertain knowledge of both the structure of the economy and its future. And in fact, you hear a lot of the current committee talk about that, right? I mean, whether it's, Loretta Mester would phrase it as sort of, this is one of the reasons we have risk management, is because we don't fully understand the current structure of the economy. But when I look out, and I think about where we were pre-pandemic, where we are now, the changes, I do think that population aging and demographics, to be fair to Professor Blanchard, I do think those are downward pressure on our STAR, and in such a way that we haven't gotten out of the woods, right? I mean, if anything, population aging now is intensifying more than it was pre-pandemic. So it's not clear to me that that's one of those downward forces that's really been alleviated. And I think one of the real cruxes is how you face some of these new trade-offs where you're balancing the downward pressure of demographics against the potential upward pressure of globalization going in reverse.
At a time of increasing uncertainty, Jonathan, how much are you seeing an increase in the politicization of the economics profession and, frankly, even of the Federal Reserve?
Yeah, I mean, I hate to talk about that because, there was such a consensus in the 1990s and then when I was the board at the 2000s, but I think the polarization that we see has seeped into many debates. I mean, we're spending a lot of time talking about things like the debt ceiling, for example, which is, a really important economic issue. And to be fair, both sides, government debt, spending levels, as well as the impact that the failure to raise the debt ceiling could have on the economy. But, we have seen this polarization, and, I do think it's unfortunate. And I think my big hope is that it doesn't really affect the institution of the Federal Reserve, which I think it's important to retain that trust and it's sort of its ability to try to be above partisan politics.
Jonathan Pingle, thank you so much. Brilliant with UBS there on the economics of the moment and just this afternoon's Fed meeting. There is interesting and somewhat attributive news out of Russia and Ukraine right now. Lisa, you see the headlines there from Russia. I'm going to go to a Dow Jones report. We need to be very careful on attribution here. This is a quote from the Kremlin's statement. The Kyiv regime made an attempt to strike with unmanned aerial vehicles on the Kremlin residence of the president of the Russian Federation. And Ukraine just comes out with bold statements.
Basically saying that it is using resources to free occupied terrorists, that Putin wasn't at the Kremlin at the time of the attack, basically pushing back on this, saying that they don't have any information on the Kremlin drone attack at all.
Moments ago, a headline, not using resources to attack foreign territories. That from Ukraine. This story is moving quickly. We'll have more on it through the morning. The balance of power this evening. On Fed Day, futures up 7. Stay with us. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The Federal Reserve is expected to deliver its 10th consecutive rate hike today since March of 2022. Another quarter-point raise is anticipated and possibly the last in this cycle, with tighter lending conditions and signs of a slowing economy pointing to cooling inflation. That decision will be announced at 2 p.m. in Washington. The U.S., Europe, and other Ukrainian allies want to close more Russian sanction loopholes. The plans will be unveiled at a G7 meeting this month. Multiple rounds of sanctions and other economic penalties imposed on Moscow since its invasion of Ukraine have battered Russia's economy, but they haven't delivered a knockout blow. In Texas, law enforcement has arrested the man suspected of shooting 5 people in a neighborhood dispute. Authorities say Francisco Oropesa was found hiding in a closet underneath some laundry. According to officials, neighbors complained to Oropesa and to police Friday night that he was firing a gun in his yard. Now, the FBI says Oropesa then entered the house and killed 5 people. The drugstore chain CVS has cut its earnings forecast for the year. The company looks to pay for 2 major acquisitions that are central to its strategy of broadening its healthcare services. CVS is buying tech provider Signify Health along with Oak Tree Health. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
We think the economy is less likely to slide into recession in the near term. We think inflation is not going to come down. And we think the Fed is going to pause in the face of these uncertainties. And how that plays out 6 months from now becomes really an interesting story. We do think the credit drag will be material and start to build. but we don't think inflation is going to come down by itself. So the case for Fed easing here anytime in the near term, I think, is not that strong.
The interesting story from Bruce Kasman of J.P. Morgan today with a global view. I really want to underscore that he mentioned China is still optimistic with 6.5% growth. To me, the China overlay, Lisa, is not a small matter in that creeping in, I'd say, in the last 3 weeks, 4 weeks is, but maybe not on China growth. And Bruce really pushed against that.
There is this feeling that perhaps we see growth now, but later, maybe not so much. I will say it has definitely been the story for Hermes and LVMH so far this year.
Well, we've seen that with the lift there. And, of course, Apple tomorrow. We're focused on the Fed in our coverage this afternoon. Maybe we should we do an Apple special? Parachuted. Romaine, we're here.
Yeah, I'm sure that would be welcomed by all.
Romaine Bostic will have full coverage, I'm sure, tomorrow afternoon on Apple with that important release. Right now, and this is a joy, David Chiaverini has been doing bank analysis, and he's one of the few people out there at Wedbush who's not only looked at bank analysis, but brought it over to the new technology of bank analysis. He's quite expert to talk about these names, particularly on the West Coast, new to so many of us on the East Coast. David, welcome to the show. And my answer here is I love in your research note you talk about rebounding deposits. Do you have deposit dynamic visibility on these smaller banks? Do you know what's going on, or is it a mystery?
Yeah, so it's a little bit of a rebound from the standpoint of a lot of depositors that were spooked in early March have come back to a few of these banks. And Western Alliance is the one that has seen, the biggest rebound of deposits post quarter end, where they had seen $6 billion of deposits outflow, and then they've since rebounded by about $2 billion. So a third of those deposits have come back. And I think it's a bit of hand-holding of their customer base to bring them back in. And then the other thing that they've done is that they've increased the amount of insured deposits on their balance sheet. And they're using a service called Insured Cash Sweep deposits. So basically it's a network of banks that basically can swap deposits to increase the level of insurance within their deposit base.
Interesting. David, I look at this, and the zeitgeist this morning is clearly the shorts. It's like George Soros and Druckenmiller in 1992 with the Bank of England. The shorts are jumping from bank to bank to bank. In all of your experience, is there a way that management can adapt to push against short selling within their institution?
Yeah, there's not much you can do other than execute on your business plan, because it seems as if, one approach would be, okay, put out more information, put out more data to try and ease concerns. But many times that backfires. And we saw that happen, just last March, because then investors start to think if a bank management is coming out to defend their numbers, then investors may think that there is an underlying problem. So I would say, management teams ought to just execute on the business strategy, talk to their depositors, keep them calm, and then let the numbers play themselves out later on. And then take initiative like Western Alliance has done, like PacWest has done, to increase the level of insured deposits within the banks to, lend some stability to the whole platform.
But David, this is no longer a crisis of confidence with respect to whether you're going to get your money back. It's also just people moving their money to places that yield more, that they can get more return. And we can see that from some of these banks that have to offer significantly higher rates than, say, the J.P. Morgans of the world in order to get people into their CDs. Does this create an existential crisis for banks that now are facing an incredible disadvantage in terms of funding costs and lending capabilities?
Yeah, I would agree with that. And our overarching kind of theme for the group is caution. We did a bulk downgrade in June of 2022 for exactly the reasons that you just brought up. And so we are expecting net interest margin pressure to continue to weigh on the group. Now, we did, see this stability in the immediate aftermath of, SVB going down, Signature Bank going down. But I think the narrative is going to shift back to what you just mentioned about funding pressures, as well as credit quality, because we are seeing that the Fed is, likely to have another hike today, and that's ultimately going to result in a slowing economy and rising credit costs. So we do remain cautious overall for the group. We do highlight a few names that we that we like on a relative basis, but unfortunately, we do think that the group is going to be under some pressure over the next 12 to 18 months.
We heard from Fallis, former Fed president of the Dallas Federal Reserve, Kaplan, overnight, and he was talking about how he expects this to become a really significant problem for the regional banks. How much are you expecting an S&L-like consolidation in this system, regardless of whether it's systemic or not, just that we're going to see tie-ups unlike what we've seen in 40 years?
I don't think it'll be as bad as the S&L crisis, but I do expect consolidation to occur. And I think that the Fed would react much more quickly if things did start to get so extreme that it could start looking like an S&L crisis. And what I mean by that is the Fed would probably look to pivot quickly and kind of cast aside their inflation target and really bring down rates to stem it. But there is potential if the Fed did not pivot, there is potential to see, a crisis truly develop.
Wait, hold on a second. That's significant. So you're saying that if we see more banks go out of business, that this Federal Reserve will just do a 180 and start cutting rates regardless of whether inflation's actually come down?
I would think so. My base case is that we've seen all of the banks that are going to go under have gone under. But if by chance we do start to see a domino effect start to occur, and instead of 4 banks going under, we have, 10 banks going under, then I think the Fed would have no choice but to pivot.
Right. John from Warwick emails in, David, and he says, ask him what your single best buy is. I mean, come on, this is the ultimate straw hats and winters. What's a Cheverini single best buy in this banking disaster?
Yeah, so one bank that got a sweetheart deal through this crisis, New York Community Bank, they acquired certain assets and deposits from Signature Bank, and that puts them in really good position to grow their balance sheet, to really cross-sell into that deposit base and really generate good earnings accretion. We're expecting 20% EPS accretion from that, and tangible book value accretion was a bit better. So New York Community Bank is one that we put on the best ideas list recently.
David Cheverini with us with Wedbush. I should point out that NYCB is an original sponsor of what we do at Bloomberg Surveillance and Bloomberg on the Economy. We're really scrupulous about when we mention our sponsors. We want to be sure everybody knows that. Lisa, I look at where we are, and to summarize, to getting to 1:30 this afternoon as well, to me the most important conversation of the day was Betsy Duke, who reminds us you got to get granular. There's a whole granular side of the Federal Reserve as an institution far away from that long table at the Eccles building.
And what she said was that she actually still thinks that inflation is a consideration that needs to outweigh some of the stresses that we've seen percolate up through the banking sector, which really is the tension of the moment. David Cheverini really put it well, where he was saying he thinks if there are a number of bank failures, the Fed's going to have to pivot and retrace and go and cut rates. Other people saying no. How do you really game this out? We don't know what paradigm we're going to with respect to where inflation is going to end up.
The paradigm and tension on inflation, and let's remember that some people look with recession, with slowdown, that we're going to get 3% or sub 3% inflation. We're going to get rates down there as well. But the present emotion is in Manhattan. They're looking at rent stabilization lifts that are unimaginable. I'm doing the simple math of 8% a year. That's not. It's believed, widely presumed, they're not going to approve that. It's going to be a much lower level. But all of us are adjusting to a new inflation. While the PhDs do a macro babble here, John Pringle was great on that. There's two separate worlds going on here.
What's supposed to happen and what actually is happening are two different things. It's supposed to be coming down, and what you're seeing, what you point to with respect to rents going up, is not only stabilization but a reacceleration in areas where you start to see rates coming in just a touch. That really speaks to the tension of the moment.
Yeah, I really want to emphasize on this Russian story. There's a lack of attribution. Everybody worldwide is scrambling. Bloomberg reports, along with others, of statements by the Kremlin on 2 drones that were down. That is not confirmed by more traditional news organizations. The BBC has a social media video with a puff of white smoke. Again, the BBC making clear that is less than attributed. We'll follow that story all through the day. It is Fed Day. We'll see you at 1:30. Good morning.